on that. I think that in preparing my remarks, I really thought about what would be most useful for the SEC staff, and my comments are really mostly about useful to corporation finance and maybe the chief accountant's office. But I'll start with something actually a little bit bigger, because and let me step back a little bit. I talked a bit about the first quarter, but and it being a tale of two quarters. But I think we've seen that throughout 2020. The second quarter, we had a bad April and May, and things started to open up in June, and a good third quarter. And now we're seeing the roller coaster continue with the resurgence of the virus. And as one of the stakeholders I reached out to is, I use the term roller coaster. He used the term as, this year is very episodic and hard to predict. And I think that Brian's comments reflect that. I think what will be particularly interesting will be the quarterly footnote in the year-end financial statements with all the quarters side by side and looking at what that actually looks like. We, as investors, sometimes we do care more about the future than the past because of the fact that we're trying to price what the securities look like in the future. And with the substantial portion of quarterly guidance pulled in the first quarter and some notion that maybe it's not coming back, we're not huge fans of quarterly guidance per se. We like longer term guidance. But really how companies will navigate the future, and not only, I think Brian said it well, going from survival to prosperity, and how that looks for every single company is quite different. And I think when Fin looks at and does the filing reviews for companies this year, they have to remember that this is very different for every company. The effects are very different, even within industries. And one of the things that I think is actually the most interesting is to listen to not just the earnings calls, but the Q&A that follows the earnings calls, because of the fact that so much of the decision-making and the things that are considered that Brian highlighted really come out and highlighted there. I drove back from the Midwest over the Thanksgiving weekend, and I had the opportunity to listen to a bunch of calls just for fun. And I think it was quite different to hear, some were very optimistic. Some retailers were very optimistic. Some retailers were not optimistic at all. Some airlines, it was actually a bit sad in, what the impacts on people, and they're disclosing their cash burn rate. So I think, it is an enormous communication challenge, and it's different for every company. And I think those differences have to be respected and integrated throughout the review of the financial statements. I think that fundamental analysis is super important in reviewing and understanding a company's results right now. But at the same time, all of the easy money and the stock market has made sort of it not necessarily as important, but certainly important to the regulator and for people looking at what the long-term fundamentals look like and how companies are behaving amidst this pandemic. I think that one of the things that has been very interesting is that, and I wrote this in a blog in June, is that crises like this are an opportunity to see how revenue behaves, what drives revenue, and how expenses, both fixed and variable, behave as you go through this crisis. I think I'll talk a little bit about some of those impacts on the starting with the income statement and then thinking deeply about the balance sheet in a moment like this. But one thing that struck me as I was preparing my thoughts and listening in to the XBRL USA US conference that we sponsor is that this is quite different in the availability of information than the last crisis. So I can sit at my computer and using tools like Couchbench and Idacity, I can search for the term COVID-19. I can see how it's used much better in the financial statements than I can in the forepart to the document, which I think is an indication of a need for more tagging and structuring in the front part of the document and use of the information. But I think it's also an opportunity to look back and say, wow, we have all this data from the past. But I think it's also a moment for the SEC to take a step back and say, in the context of how information is being consumed, and I like to say people aren't printing these out and reading and counting the number of pages. They're consuming them using technology, data providers, at various different degrees of structuring from the data providers. But I think it's very important for the SEC to think about, in 10 years' time, if we have another crisis, what will the data look like, and what do we want, how fast and what pace of change is necessary? Because one of my colleagues was laughing at me yesterday and said, Sandy, 2 years ago, you said that we may have self-driving cars before we have a better income statement or better disclosures. And that it's important to consider that the pace of change as it relates to digitization of this information is very important. But I would also say that, interestingly, I can do this much easier in the context of the United States than I can in Europe, who don't have tagging and a database yet. So the US is ahead of that, and you can see the differences of that. So I put that out there for the commissioners and for DERA. I think one of the things that I found super interesting about the excellent SEC guidance at the beginning of, I think it was March and April, at the bottom of one of them, it was an appeal to companies to disclose forward-looking information, not just for investors to understand what was going on with the company, but for policymakers to understand what elements of the economy needed to be considered, and that because the impacts, as Brian said, have been very different. And I think it's a moment to step back and say, wow, this massive database of tagged data is such an interesting and useful suite of information about not only the individual companies, but the U.S. economy overall. I think that's very interesting. As we think about the analysis, obviously we think, and many people start with the income statement. And I'll just quickly run through these because my comments are long and my time is short. But what? Some of the things we learned is that there was, during the last several quarters, is that there's a lot of discussion of revenue and drivers of revenue and analysis of revenue or revenue that didn't happen in a way that makes one question that some of the segment disclosure can't be better, and that some of the revenue disclosures can actually be better, because it was clear from comments that key members of the management team are actually looking at things in a bit more detail than say the segment or revenue footnotes would actually disclose. I also think that it's super important in the context of revenue to think about the impact of the crisis on short-term contracts versus long-term contracts. And I think for CorpFin and the Office of the Chief Accountant, as they go through and think about this as the year end is filed, I think those are some interesting points of focus. Obviously, when we look at expenses, I've talked a little bit about this. Brian talked about health and safety. I know it was talked about in May. I listened in. I've spoken briefly about, the notion that this is a remarkable time for companies and investors to understand their true nature of their fixed versus variable cost. When revenue collapses or revenue ramps up immediately, how does that behave? And there's been a lot of discussion of that and segregation of expenses to highlight that things have been kept in place because they expect demand to come back. And I think also one thing that we could spend the whole time on is, the implication of the CARES Act and various tax implications to companies. But one of the things that I've written about and talked about is non-GAAP measures. And in the spring, we all saw about EBITDA. And actually, I used CalcBench to search for the term in earnings releases and filing documents, and only 3 companies actually used it. But one of the things I highlighted is that I understand the term may not be appealing, people may not be using it, but investors need to be cognizant of the extent to which non-GAAP measures have been used, or even if they're truly non-GAAP measures, in explaining their results. Because non-GAAP measures, we all know disclosure is about communication, and non-GAAP measures are one of the highlights of how you actually do that. So I've highlighted questions for investors to ask about why you need the new measure. Do the adjustments arrive at a more normalized measure? How useful is the new measure? And will new measures affect compensation? Brian mentioned compensation, and that's actually one of the things that we're thinking about, like how will this year and management's ability to handle the crisis be incorporated into the analysis of compensation? There's a few more things I could say, but that's the broad strokes. I think during any financial crisis, or I shouldn't say financial crisis, sorry, any economic crisis or recession or distress, investors move from the income statement to the balance sheet. And, I was sad to see the remarks about the contractual obligation table and it not necessarily being a table, because having been a preparer and an avid user of it, it's a fantastic way to determine how quickly payments are due and when cash is going to be due. Obviously, there was a lot of discussion in the first quarter of companies' cash balances and increasing cash balances. And if you listen to the third quarter, there was actually talk in companies that were, surviving this well about what they were going to do with this extra cash. And using CalcBench, if you look at the trend in cash balances for the S&P 500, they went from about 1.6 trillion at year-end 2019 to about 2.4, 2.5 trillion in the 3 quarters of 2020. I also took a look at, in the first quarter, I had provided some thoughts on impairments and that they seemed quite low. Actually, I thought it would go up. In the second quarter, it actually went down with only, I think we had 49 billion in impairment charges in the first quarter, 30 billion in the second quarter, only 2 billion in the third quarter when most people do their quarterly or their annual goodwill impairment assessment. So 80 billion in the first 3 quarters of this year on a goodwill balance of about 3.5 trillion in the S&P 500. And we had done some work in doing our goodwill comment letter to the FASB that amounted to about 40% of the equity of the S&P 500. So it is a bit remarkable that there isn't more goodwill impairment. When you see it and you look at the companies, it's obviously in oil and gas, heavily in oil and gas and retail and cruises and the like. But it is surprising that it isn't higher. And this possibly is buoyed by people's looking at their own stock price. I think one of the other things in the impairment side that one of the stakeholders I reached out to talked about was their lack of seeing impairments on right of use assets on operating leases. And so I did a little bit of a search for that in using CalcBench, where you can gather all of the right of use assets for operating leases, and they're about 550 billion-ish. And there are only about 500 million each quarter of impairments, or about less than 1% for the year. So the impairments on right of use assets was quite low. And given that both the SEC, or not the SEC, the FASB and the ISB had made some rulemaking or discussions about rent abatements and deferrals, it'll be interesting to see how those deferrals and the like sort of bear out over the year. I didn't have a lot of time to do anything on CECL, but some of the calls for the banks were very interesting in talking about the increase in deposits, and that some things actually didn't seem as bad as you would think, but there was also the notion that the federal government has provided a bridge, but it's not clear whether that bridge is long enough. There's obviously a lot of other asset impairments in oil and gas. But those are some of the things that when we look at this this period, obviously we also look at cash flows. I did a quick search. I'm a huge fan, having lived in a regulated environment where cash doesn't flow up to the parent easily, of parent company cash flow. I couldn't find in a quick search. I won't say that it was, super diligent. A lot of parent company only cash flows, which are generally only provided at year end, but during periods of financial stress, the SEC rules actually say you should provide them. So anyway, that's that's probably quite long, but I think it's a good overview of sort of our view of the quarters, our look at the income statement, our consideration of the balance sheet. And really, I think for the SEC, and particularly Corp Fin, as they review things, it's really a tale of how is every company impacted by this. It's quite different. So I'll stop there.
Thank you very much, Sandy. Appreciate the comments. I think they segue very, very well into Professor Taylor's presentation around the data as it relates to that. So we'll turn it over to Professor Taylor for your comments.
Okay. Can everybody hear me okay? Give me a thumbs up if you can hear. All right, thumbs up. All right, now I'm going to do my next technology check, which is see if I can share my screen. Let's see how that goes. All right. Everybody see the screen? Give me a thumbs up, Shen, if you can see the screen. Excellent.
Yes.
All right. Okay, so I have written an academic paper with some of my colleagues at Stanford University, Dave Larker, Brian Tyan, and a colleague at Wharton, Bradford Lynch. And the paper is really a fact-based paper about how companies are actually disclosing COVID-19. So, in deliberating or considering policy recommendations, it's important to consider the evidence. And what we're going to try and do here is we're going to try and present evidence across all publicly traded companies about how they are in fact disclosing COVID-related items. Okay, so you can think about this as a data analytics exercise where we are going to go to Edgar, we are going to suck down every 8K, 10Q, and 10K, and then do some text parsing where we look at keywords and how those keywords are mentioned, who's mentioning them, and when they're mentioning them. So not surprisingly, beginning in January, there was very little disclosure. Things pick up in February. Moderna was actually in the news back in January. They were the first one we found to actually disclose COVID, and it was related in a good way because they said they had a promising vaccine technology. Starbucks was a little bit later. They were the first Fortune 100 company, and they disclosed in some sense, some bad information. They basically said that their China operations were being affected by this pandemic at the time. And so by the end of May, we're at 99.6% of companies disclosing these related keywords. Now, there is 4% that is not, and we'll get into why that might be in a bit. So beyond, who's disclosing in 8Ks, 10Qs, and 10Ks, what we wanted to dig into is within a given filing, what's the time series look like? Okay, so within a 10Q, within a 10K, we're going to dig into each one of those filings. We're going to look at where it appears in the 10K and the 10Q. Is it in the risk factors, the business description? And then we're going to do some topic analysis to look at the sentence in the paragraph around each of these items. Okay. And again, keep in mind that this is the entire universe in some sense of publicly traded companies that file with the SEC. So the first thing we want to do is by March, we wanted to look at, industry trends in March. And so perhaps not surprisingly, if firms are complying with the disclosure guidelines to disclose material events, what we see is the airlines and the travel industry, they're at a 100% disclosure rate. So almost everyone in those industries has disclosed some effect of COVID as early as March. Whereas if you look towards the bottom of the industries, utilities sort of lagging behind in March, by March, pandemic hadn't really sort of been appreciated yet, financial services and telecommunications. Okay. Now, what's interesting is beyond industry trends and beyond time series, we can look at the topics. So looking at the topics of COVID disclosure from January to May, what we see is that 60% of those disclosures are caveats on forward-looking statements. Well, what is a caveat on a forward-looking statement? So I have an example here of what we mean by a caveat on a forward-looking statement. Certain statements may constitute forward-looking statements within the meaning of federal security laws, blah, 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 legal boilerplate, including but not limited to the outbreak of COVID-19. Now, that is more of a disclaimer as opposed to providing information about how COVID is affecting the company's business operations. So it's important to note, when we looked at those trends earlier and we saw we were close to 100%, that includes such boilerplate disclosure. Okay, so we have to dig beyond just looking at, does a company mention COVID-19, because they could do it in this boilerplate disclaimer fashion, and actually talk about how COVID-19 is affecting operations. So our second most popular topic is cash or liquidity. And so I have an example here of a cash or liquidity disclosure, which is a bit more meaningful. Our key liquidity objective during unprecedented and uncertain times is to prioritize actions that preserve cash. Okay, so as we get into later crises, it becomes clear, okay, maybe we actually need to not just disclaim, but provide information about how the pandemic is associating our liquidity, how it's affecting our sales and revenue, how it's affecting our supply chain, our debt load, our employees, M&A, so on and so forth. And so there was a discussion of, EBITDA, and so there is some discussion of how COVID affects EBIT. Okay, so that's topic. What is interesting about this, and it does speak to companies evolving their disclosures over time, is we can see a change in topics as the pandemic gets much worse. So in the beginning of the pandemic in February, 41% were disclosing supply chain issues. Okay, so this could be a supply chain that runs through China or that runs through Asian companies. But by May, the number one disclosure was the disclaimer on forward-looking statements, and the number two was cash. So cash was not really a concern in the beginning, but as the world learned that this pandemic was not going to be going away very quickly, then there were legitimate concerns about liquidity, legitimate concerns about debt load, about sales, and about employees. So this does speak to the fact that companies are actually changing their disclosure as the situation evolves. Another thing that we've found in the data is that appears to be, again, consistent with companies, disclosing information and adverse effects properly, is that there was a correlation between the discussions of COVID, so this is the extent of discussion, the number of mentions, and the reliance on China for a revenue source. So we partition our data based on whether you get more than 10% of your revenue from Chinese operations and less than 10% of your revenue. So this isn't supply chain. This is actual revenue from China, so sales in China. And what we see is we do see more discussion by companies that relied on China for a greater proportion of their revenue in the outset of the crisis by March and April, but now it is pretty much flattened out by May. And if you extended this, it's also flatlined subsequent to that. So then we look at where it's being disclosed. Most of the time, the disclosures are in the risk factors. So that's because the forward-looking disclaimers that I talked about before, which really don't have any depth of information, those are going to appear in the risk factors. We do see some discussion in the actual financial statements themselves. in the MD&A. And there's a very few number of companies where they actually changed their business models in response to COVID. So if you've been following the news, there have been a few companies that were sort of, just barely limping along before, and COVID has come along and they've rotated their entire business model to be about COVID testing or supplying PPE or hand sanitizer. And so about 5% of companies actually changed the business description in response to COVID. So now the next question is okay, we see these disclosure patterns. These are sort of, fact patterns in how companies are using disclosure. Does that mean things are operating well? Are companies actually disclosing the economic impacts of COVID in a manner consistent with the Commission's guidance, or should we have additional guidance be provided or additional rules? And one way to think about that is to look at whether companies are disclosing, companies that are experiencing bad news or bad economic shocks have a higher rate of disclosure of those shocks. So what we did is we looked at the performance of companies prior to their disclosure and then the amount that they disclosed. So here what we see is that those that are disclosing COVID effects in March in their 10K and their 10Q performed much worse previously. So over the past 30 days before the filing, they performed about 10% worse than those that made no mention of COVID. Right? And then on an industry-adjusted basis, so rather than looking at just raw return, let's just look at how they perform relative to the industry. Those firms that didn't disclose anything about COVID in March were actually at their industry average or slightly above at 2%, whereas the companies that were disclosing COVID were much lower than their industry peers. So this does appear to be some evidence that those companies that are struggling are, as a result of COVID, do appear to be providing more disclosure. So it's not the case that across the economy, firms are hiding bad information in their, by not disclosing it in COVID. At least that's what the data suggests. So now I just want to cover an interesting case study because the case study is important. It's educational. I think I cover it with some of my students about how to think about rules versus principle-based disclosures with respect to COVID. And as some of the commissioners mentioned earlier in the call, you can extend this logic to ESG disclosure and climate disclosure. And so the case study basically revolves around an industry. So I've taken here, you could see the beverage industry. I have Keurig Dr. Pepper, Monster Beverage, and Fizz, which is National Beverage Company. They make the La Croix sparkling waters that you might have seen in Costco or Whole Foods. And what I've done here is I've plotted the industry trends, the stock prices of each of these companies, so that you can see as a whole that all of these companies are subject to similar economic shocks, right? So there's this economic shock in March. Keurig Dr. Pepper fared much worse than Monster, and all of which are pretty similar and they're pretty much homogeneous. What's interesting about this is that this is just, I should say, what I'm going to talk about here isn't unique to the beverage industry. But you would think that given that the beverage industry faced similar economic shocks, that there was similar disclosure across these firms. But there was not. Okay, so now let's turn to how these three firms that experienced similar shocks, at least according to their stock prices, had different disclosures. Okay, so the fact that Monster is disclosing in March about its supply chain risk in its 10K and its 8K, and then we basically have Keurig Dr. Pepper picking up with its 8K and 10Q in its file. And by May, Monster had 78 to 80 separate discussions of COVID in all of its filings. Keurig Dr. Pepper comes 45 discussions of COVID, but National Beverage Company has 0. They haven't discussed it by the end of May. And so if you scroll this chart forward, the first time that National Beverage discloses something is in their 10K filed in July of 2020. And this is the disclosure. I've excerpted this from their 10K. And it's a forward-looking statement disclosure. You know, there's this pandemic. It could affect things adversely. We're not really sure. So an interesting question is, you know, is such a disclosure sufficient? Now, not sufficient in a legal sense, but is it sufficient in the sense that this is what we are comfortable with existing disclosure rules promulgated by the SEC prescribing? Or do we want to mandate that companies disclose more than this blanket disclosure? I would also point out that this is actually the only disclosure of COVID by a national beverage company through as of yesterday. So if you look at this disclosure and you're thinking that it's insufficient, then what that means is that we do need to actually potentially call for some change in mandatory disclosure rules related to COVID. Now, in considering what those rules or those changes should be, I would urge you to keep in mind the trade-off between what's known as a rules-based disclosure and a principles-based disclosure. A principles-based disclosure is what is the current regulation that says, please disclose adverse events, material events related to COVID. And then it gives companies discretion about what those events are, what materials considered, and how to frame that disclosure. And that's the current regime, and this is sort of the outcome of that regime. Another regime is a rules-based regime that says specifically, please discuss the effect of COVID on employees. Please discuss the effect of COVID on supply chain. It basically mandates very specific types of disclosure. Now, both of those systems can work, but there's a key different ingredient. And in the principles-based disclosure, a key ingredient is robust enforcement. Robust enforcement to basically signal to issuers, we gave you leeway in what you can disclose. We gave you the discretion. We're drawing a line in the sand with our enforcement actions. The following disclosures are inconsistent with principles-based disclosure. And through those enforcement actions, that can alter the principles-based disclosure to get everybody on the same page about what the minimum standards are. But without robust enforcement, there's not going to be any minimum standards set by the commission, and there will be a race to the bottom. And so with rules-based disclosure, enforcement isn't as key, but with principles-based disclosure, which is the current regime, we need robust enforcement to set a lower bound on what's considered acceptable. Thank you very much for inviting me here and for listening to the talk.
Thank you very much, all of you, for your comments. Very insightful, very helpful. I sent a little note in the chat box. If any of the members of the committee have a question, please, write a note in the chat box that you have a question, and we will get to you in order of what people are sending in. So, but that being said, let's open it up for any questions that we've got. If any of our commissioners are still on the line, are there any questions from any one of the commissioners that are still on the line? Okay, hearing none, we've got a question from Jennifer. Jennifer, if you would unmute yourself and ask your question. Anybody else, please put, let me know you have a question in the chat box.
Thank you, Chen. And just a really informative panel. So thank you to all three of you for your comments and coming to meet with the committee today. So I'll put two questions out there. The first is for Sandy. So Sandy, you noted the Commission's suggestions for more forward-looking statements, how important those were in the spring, and just in general during this pandemic time, not only for investors, but for policymakers. And so I'm curious if you have any observations about variations potentially that you saw across firms or types of firms in making those forward-looking statements. And then for Dan, your research is just fascinating, so thank you so much. The case study, I understand that the research technique probably allowed you, because it was a few firms, to really look and read through each of the disclosures. But for some of your other charts, you were speaking across thousands of firms. And so I'm just curious about your technique for identifying. I think you mentioned some firms expressed concerns about COVID, or you spoke about the amount of disclosure that they had. And I'm curious if you were doing the amount by counting across the different sections, or whether you were doing some more textual analytics to determine amount, or whether firms had concerns. Maybe Sandy first.
Sure. I thought that the work that Dan did was really instructive when it came to forward-looking information, in the sense that it talked about most of the reference to forward-looking information was in the caveat, and it was very generic. I think that there hasn't been a lot of the forward-looking information that investors would really like. I understand completely the high degree of uncertainty, and as I said, the sort of episodic nature and the unknown of what that roller coaster looks like, and management's concern about it. I think that the reality, though, is that investors are going to make assumptions about the future, and that companies are well served to provide that guidance. I get that. And I don't use, when I use the term guidance there, I don't use it in the traditional way. I mean a view of the future. And what they see. There was lots of discussion on calls that was clear that companies were doing scenarios, but not a lot of discussion of what those scenarios actually yielded. And in fact, one analyst asked and they were told, no, we're not going to share those, right? But the reality of it is that as things occurred during the year, investors are going to make estimates about the behavior of the revenue and expenses and produce their own estimates of what they think those are. And that I think it's useful for companies to give a consideration to that. I think, as I said before, the conversations within some of the earnings calls, while they talked about the current effects, and they aren't necessarily forward-looking information, they have insight into the behavior of the revenues and expenses that investors were using to make their assumptions. So I don't think that it was all out there. But one other thing I would say, too, is that I didn't see within the financial statements, particularly when it comes to things like goodwill or long-term contracts, inherently, there are assumptions built into those that give you a reflection of what management thinks. And I didn't see that those markedly changed, even though the effects could be quite dramatic. So hopefully that answers your question.
It did. Thank you.
Yeah. So to your question, Jennifer, there's both let's call it a naive model and a more sophisticated model for the topic analysis. The naive model is, as you correctly pointed out, it's a simple count. How many times did certain words like COVID, hand sanitizer, PPE, pandemic, epidemic face mask, just how many times did those show up? That's kind of what we would call the naive model, as it's a simple count. And what we found is that does seem to correlate with the amount of number of sentences and number of paragraphs on each topic. The more sophisticated model looks at within those paragraphs that mention one of those keywords. You can do a topic analysis of what is the actual, what nouns and what subjects appear to keep being used. And so that's where when we got into the actual content, is it forward-looking? Is it supply chain? Is it earnings? Is it cash, liquidity, and debt? And so there, in the more sophisticated model, we do something more than a simple count. We're actually letting the data speak to what the topics are. And for those, I know we're being webcast. For those of you who are really geeky into natural language processing, the papers on, it's up there on the internet, and you can read all about the technical details. But I will save the commission me geeking out about those technical details.
All right.
Thanks, Dan. That's helpful.
Let's go next to Paul Mahoney. Paul, go ahead.
So this question is mostly for Professor Taylor, but I'm certainly happy to hear from other panelists as well. So if I'm an investor during the period of your study, I'm of course being bombarded with what we might call systematic information about systematic risks associated with COVID, the daily numbers of infections and hospitalizations and so on. All of the data that we were receiving or information we were receiving about potential vaccines, potential treatments, et cetera. And then, of course, we have the kind of firm-specific information that's coming in the 10Ks and 10Qs. And I guess from a policy perspective, I'm interested in knowing the relative importance of the two. And I guess I'd be interested if you've looked at all at the sort of stock price reactions to COVID, sort of firm-specific disclosures and how those sort of compare to other types of firm-specific disclosures.
I think that's a good framework, Paul, for thinking about it in terms of there is some systematic shock, the COVID pandemic, and then there is a firm component or a firm response. But something to keep in mind is that when we often think of a firm response, we think of something that's idiosyncratic, that's unique to the firm. But what we see in the market responses and the stock prices is that, and the disclosures, is that it's providing information about the sensitivity of the firm to the macroeconomic pandemic. So, if I don't want to go back to Finance 101, but if you can think about like a beta or some exposure to a macro factor, that's what these disclosures are effectively telling investors. They're telling what's our exposure to this macro shock, and we do see, from the stock price data, at least in the study, that it does appear to be that firms that are more exposed tend to be doing more disclosure.
Okay. Paul, did you have anything else? Okay, hearing nothing, we will move on to Christopher. You had a question for Brian.
Yes, thank you very much. Just a quick question clarifying something Brian Hall said. Brian, you mentioned early in your remarks, you referred to communications with shareholders about COVID. Just seeking to clarify whether those were sort of unusual, out of the ordinary communications reflecting a heightened awareness and a heightened concern from shareholders, or whether these were just mentions in your routine quarterly calls and so forth.
Yeah, I would say it's across the board. We certainly had to focus our efforts on addressing the things that we believe that were relevant to the investors and putting that in our normal disclosures, whether it be on our quarterly releases and our SEC filings, et cetera. But the research coverage side, which we have a number of kind of niche research groups that really concentrate on recreational vehicles, as an example. We certainly had a much more heightened conversations with them over the really. I mean, it started at the beginning of the year and it exists today. Because if you just think about the products and the things that we're selling, they're consumer discretionary products. I think intuitively, everyone would have initially thought that these things aren't going to respond the way that they did. So there was a much more aggressive push from investors and research side. And we were engaged in a lot of conversations and then trying to accumulate that information and put it into our regular disclosures as much as we could. But it's really across the board, I would say. And that continues today because there's certainly everyone's still challenged with understanding why this is happening and, how much risk still remains. And as soon as there's a vaccine, as an example, does it all go away? So those are the types of things that we still deal with today.
So if I understood you correctly, what you're saying is not only was there a lot of Q&A on your regular quarterly updates, but you were actually getting inbound calls during the course of the quarter for people who were trying to update their models.
Yes, absolutely.
Thank you.
Excellent. We'll go next to Ted Daniels has a question.
Yes, my question was for Ms. Peters. You mentioned goodwill impairments and asset impairments. That's sort of new to me. And then how do you think that would impact the shareholder value if it's not disclosed?
Well, I think what currently there's the big debate about the FASB going back to amortization versus sticking with impairment, and we have actually done a survey that's yet to be released that asks what investors think of that. And I think that what's interesting is that there's a clear indication by investors that impairment is a useful bit of information with respect to the performance of the business and the assumptions inherent in the business as management sees it. So they see impairment as an important signaling device. So many people talk about, well, impairment is added back, so it's not important, just like amortization is added back. Well, they're only added back because they aren't cash today. They are cash that went out and hasn't turned out to be as was expected in prior periods. So the interesting part of a lack of impairment disclosure in this market is that business must not be that bad, or they perceive it as being very short-lived, or they're looking at, some people, I always find it ironic that people look at their own share price and say, well, look at the market seemingly must know more about the company than I do. So I shouldn't impair it because look at the high stock price, right? And that's sort of ironic given the company has so much more information. So impairment is a useful indicator of what management's expectations are of the performance of the business. In putting the assets, if you go down the list of all of the assets, goodwill is more of a holistic on the businesses that have been acquired. Rent is sort of the right of use asset on leases is an interesting one given all we've heard about what's happening with retailers. If you look at about $1 billion that's been written off this year, about a third of it is one retailer, but I was surprised when pointed in that direction by how few retailers were actually in there. And that should tell you something about their business. But I think what you are seeing is in the broader category of asset impairments, say in the context of oil and gas, that there is, in the first quarter, there were lots of impairments. And right now you're seeing that there is sort of a capitulation that there needs to be a write down of these. They aren't worth what we thought they were worth. So they are an important signaling device for investors about what management sees as the cash flow prospects of the business and the entity, or the asset, sorry.
They should be regularly disclosed?
I'm sorry, it cut out.
So do you think they should be regularly disclosed, impairments be regularly disclosed?
Well, I think the issue is the key issue on impairments is that management takes them too late. They're too optimistic, and that the market generally takes them before management does. but it's still important to look at them and to look at the assumptions that are being made and the timing of them, and actually what it's saying. You can actually learn a lot about the timing of impairments, about the behavior of management, and how willing they are to admit where things stand.
Excellent. Let's go next to Heidi Stam.
Hi, thank you, everybody. This was really an excellent panel. You know, we set out to understand, you know, sort of what are the lessons learned from this, from the coronavirus pandemic, and you all really, I think, very thoughtfully put forth your observations, which are really interesting, and I think very well coordinated. You sort of built on each other. We've actually been in an actual laboratory of disclosure, and I think you've all made use of that. I am particularly taken with Professor Taylor's research and presentation of the information, because to me that raises the key question for the commission and also for us, you know, as we think about what's best for investors, which is there's an incredible tension between principles-based disclosure and specific rules-based mandates. And I appreciate very well that Professor Taylor asked the question, should we mandate more specific disclosure in light of this live laboratory experience that we're in the middle of, or should we look to more principles-based disclosure and look to enforcement to help us with that? I think all panelists recognize that disclosure is helpful when it is specific to the issuer, and it really is the most meaningful there. So I guess I would ask each of the panelists their views on whether there are specific recommendations that any of you think we should be thinking about in terms of either improving our rules-based approach to these issues or a more principles-based and enforcement-oriented approach. And I would ask Professor Taylor to jump in first, in fairness.
Okay, I'm happy to jump in. Thank you, Heidi, for the question. I do think you kind of nicely summarized the central tension, both for the committee and for the commission as a whole, as it goes forward on this particular disclosure issue and on others. You know, another thing to keep in mind when making this decision between rules-based and principles-based is, has COVID affected the SEC's enforcement capability? At least the evidence that I have seen has suggested the answer is yes. And so if you're in a world where, for whatever reason, budget constraints, some sort of, you know, natural disaster, pandemic reduces enforcement capability, then, you know, that potentially might want to be taken into account when weighing rules-based versus principles-based. You know, I have normative beliefs about which one would work better, but, you know, that's also informed by sort of, it's not, you know, we can agree what the facts are, evidence-based policymaking, and then interpret the facts very differently. I personally would like to see a more robust enforcement of existing principles-based disclosure. In my opinion, and the data bears this out, at least that I've looked at, the enforcement of financial issuer disclosure, accounting fraud, has fallen, not just under COVID, but it was on a downward trend before. And so, you know, my inclination is to suggest principles-based, but then beef up the enforcement capability sort of beyond. My recommendation would be beyond where it's ever been before. But that, you know, that requires more. You know, everything here is a political decision, has to go through a political process. But, you know, my assessment is that, you know, there has been you know, if SEC enforcement, you know, they put out their annual report, they have done a great job at bringing in record hauls of money and settlements and whistleblowing payouts. But I do think that there's a lot of opportunity here for additional enforcement to sort of strengthen and say, look, this is what we meant by principles-based. This is not what we meant. But that's more of my opinion and assessment than it is based on facts.
Thank you. That was very helpful. If anybody else would like to comment, I'd be interested also in hearing those views.
Yeah, this is Sandy. I would like to comment because Professor Taylor's last slide in question about enforcement was actually, I thought, an excellent point in question, and something that, we like a balance between rules and principles. It's hard to create a rule about COVID-19 when we didn't know that it was going to happen. But I think that there's a blend there, and I think that the SEC. I think that rules around business and management discussion and analysis and the like necessarily have to be, to a degree, principles-based. I think that the commission did a nice job of explaining what they expected in a forward-looking way from companies in the guidance that was provided, and I thought that was an excellent scenario situation, and it does those also in the context of like Dear CFO letters. But I think the one thing that was missing and is missing is that the SEC came out and said, this is what we think you should do, but they didn't come out and say, okay, so we've looked at first and second quarter, and here's some, without using company names, because I'm not into the naming and shaming per se, but did we get what we hoped for? And how do we nudge a little bit more into the context of forward-looking information, impairments? I think more of a assessment of where things stood and what could be better, because I know that they're looking at it, would be helpful to get a result that reduces the need for enforcement. And I think that my comments around CorpFin looking at things are that this is a period where they're going to have to look closely, and they're going to have to understand the business, and they're going to have to understand this event, how it runs through the business, how it correlates to the risk factors, and whether or not the company did a good job of explaining it. And I think that effect is actually not just this year, but will linger for the next year or two as this happens and continues on in 2021, and as this becomes a reference year. So I don't think I mentioned that one of our concerns was, these are quarters when companies throw in the kitchen sink, or these are years when companies throw in the kitchen sink of items. So, for example, I found in our search a company that had a restructuring related to COVID, but revenues were up, right? And it didn't seem to sort of jive. And a company that was completely benefiting from the crisis because we were all buying their products, but describing it as a risk, but not really saying it was an opportunity or was more than an opportunity. It was a positive event. I think that understanding what happened and CorpFin working closely with enforcement or highlighting some of these things are important. But I'm sorry, I lost my train of thought there. One of the things that will be important in coming periods is how companies compare the future years to this year and discuss it, right? Because next year, if the world is so much better, we can't be talking about, look, we've done a great job, everything is better. Well, we got a vaccine and everything is better, right? I think that explaining that for the next 1, 2, and 3 years is going to be important for the SEC, CorpFin to look at, and for enforcement. So sorry for the long answer, but I think it was a great question.
Heidi, Dan, I think Professor Taylor had a follow-up to piggyback off of Sandy's comments as well.
Yeah, so Sandy's comments were good, and Heidi, I mean, again, your question was excellent in terms of cutting to the core. It would be nice if one could illustrate for companies what is considered unacceptable principles-based disclosure without needing to have enforcement actions, right? One way to do that is actually to look at what the FASB does for accounting standards. So when they put out a new accounting standard or the accounting standard is controversial, they publish negative guidance. So a good example is SAB 101 way back when, which was for revenue recognition. And they phrase that guidance as a frequently asked questions without naming specific companies. They say, like, they will take a boilerplate guidance, and then the question will be, is this boilerplate guidance considered acceptable within principles-based? And then the FASB will put in an answer, no, and here's why. And then they'll take another boilerplate disclosure. Say, is this acceptable? And then they'll say, no, and here's why. And providing that type of frequently asked question or those negative examples can help companies, stay within the principles-based disclosure, but recognize that it cannot be a race to the bottom. Because if you don't comply with, if you don't make sure you're above this minimum threshold, then it's a pretty clear enforcement case. So, it shouldn't. I would think it would neither be politically nor logistically difficult for the commission to come up with some negative examples of what would be considered unacceptable COVID-related disclosure.
Yeah, thank you again. I think, the commission obviously is going to need to use all of the tools in its toolbox, not just to think about this specific situation with COVID, but, again, this is a laboratory for us to experience. And obviously there will be future events and circumstances that are going to broadly affect the quality of disclosures by corporate issuers. So it's a great opportunity. I thank you all for your comments. They're extremely helpful.
Thank you, Heidi. Let's go to JW.
Thank you, Jen. And thanks to all the panelists. I really enjoyed all the substance of the discussion. And thank you, Brian. When I first logged in, I thought Tom Selleck was on the panel, but it turns out that I think you're going to win the mustache contest. So I think you're ahead. Just a few observations about the discussion so far. First, I would be cautious about the observation that enforcement, that some increase in enforcement with respect to accounting issues is necessary or required. The observation that accounting, bread and butter accounting issues is a smaller percentage of the SEC's enforcement agenda than it has been in the past is insufficient to suggest it should increase. For example, restatements are down. Why would enforcement actions involving accounting issues not also be down as well? That would be, I think, an expectation. Secondly, thanks for mentioning FASB, because that was what I wanted to indicate, that there's a wealth of guidance from FASB on COVID-related issues. Just do a search on FASB.org, COVID, and I've tried to read it in a day and a week. You won't be able to get through it all in that period of time. And I think, frankly, with respect to a lot of what we're talking about, FASB is a better source of guidance than the SEC. We shouldn't always assume the SEC is the principal source of guidance, particularly on accounting issues, because it's not. OCA has a vital role, and I have a tremendous amount of respect for OCA's work, particularly with related to COVID and the guidance they've done and the speech that the director has done. But FASB is just as important, and I think they're doing their best to provide guidance. It's out there. If there's some great suggestions here about Q&As and sharing some language, on an anonymized basis, what not to do, that sounds like a great new speech for the OCA director to do at some Christmas event. That's a great idea, but I would be hesitant to translate that into in an enforcement agenda. In part because I think one of the things you have to remember in this discussion about principles versus rules is that the SEC has some strong requirements under the Administrative Procedures Act to provide transparency and public input into its rulemaking, particularly rulemakings that build off of FASB disclosures that require additional things in MD&A or in risk factor disclosure. So I wouldn't want to encourage the SEC to sidestep its Administrative Procedures Act obligations. Also, I think it's very fascinating to hear the observation that one of the primary disclosures in a number of COVID-specific disclosures has been boilerplate legal issues. I wouldn't dismiss that. I think that's a symptom of something bigger, and we got to get to what that symptom is. And I would suggest it's a symptom of failures in the forward-looking safe harbor in the Private Securities Litigation Reform Act. There's a tension, and we haven't. We've talked about enforcement, we've talked about guidance. We haven't talked about private securities class action liability. And if I'm an issuer and I'm whether it's positive or negative information that I'm predicting about the future, I'm going to be concerned about 34 Act liability going forward. And the PSLRA is not perfect. The forward-looking safe harbor is not perfect protection. Particularly, most circuits have held that whenever you're making a forward-looking prediction about something that also relates to something that happened in the past, that's COVID, right? That's totally forward-looking prediction about something that also relates to what's happened in the past, the effects on your company in the past. It's a continuous sort of thing you're analyzing with COVID-specific disclosures. You don't get forward-looking safe harbor protection. It infects the forward-looking prediction and doesn't protect that forward-looking prediction. That's something I think the SEC statutory reform would help. But the SEC General Counsel's Office could get on that issue right now with its amicus program in private litigation. And I would encourage the SEC GC's office to focus on this issue and the circuit splits that have, I think, watered down the forward-looking safe harbor. This is the kind of thing we need the forward-looking safe harbor for, to encourage voluntary disclosure. And I think that I would point to that as the cause of the real focus on boilerplate looking forward. I don't know if Brian has a different perspective since he's in the salt mines here, but I wanted to throw that out there for everyone's discussion.
I will add there, JW, just since you called me out. First of all, thank you for the compliment on the mustache. But I certainly agree with your comments. As I was sitting here listening to all this, the rules versus principle-based disclosure, and I always think, boy, accountants love rules. I know we all do, but that's one thing that I would disagree with. That principles-based, I still feel very strongly is the way to go. And I have a hard time understanding companies that have went through the last 11 months thinking that it didn't warrant some kind of additional disclosure. I mean, I've got, we're not a large public company, and I have teams of people that were, combing through FASB rules, combing through SEC recommendations, looking for any guidance that we could find to help push us and guide us through our disclosure process. So I certainly feel that, I don't like the idea of enforcement, getting somehow some additional resources to come after companies for those types of things, because it seems as though that, I would take a little nudge, because if you didn't recognize it, you needed to disclose something different during the last 11 months. I don't know what world you're living in. Just thinking of all the investor phone calls and all the questions that we're getting still to this day, it's got to lead you to additional and good, clean, clear disclosure. So those would be my couple comments there.
Just to think about some of the things that JW said. I mean, no one wants to see enforcement actions unnecessarily. But it's kind of like, I have 2 young girls. It's kind of like a disciplining mechanism. You can tell them, please don't do this, or please do this. And you can ask them 3 times, 4 times, 5 times. But at the end of the day, you do need to have a stick. Now, most kids, hopefully, you don't need the stick, and they listen when you ask them the first time, the second time, and the third time. But it is important to have a stick in the toolkit, so that when there are those 0.4% of companies, it may not be, Brian's company, but there are companies out there that I would argue are, without naming specific names, that I would say are not actually disclosing any meaningful information other than boilerplate about COVID. And so the question is that optimal? Is that what we want? Are we okay with that? And then if the answer is yes, then we don't need to take any action. And if the answer is no, that's not what we want, then how do we get those companies to shift? And one could be to say, assume that they didn't know any better, and to publish some negative guidance to say, okay, look, the following, is unacceptable. Just like you would potentially when, parenting a child. The following behavior is considered unacceptable, do better. Another is to just come in with the stick and start punishing. I prefer the former approach to public companies and to parenting. But I do think it's important that there is a disciplining role. I mean, we have the SEC as they have an enforcement function for when things get completely off the rails. And I wouldn't want to see that enforcement function diminished, certainly any more than it already has. One thing I will add back to the data, as separate research projects, we have obtained through FOIA process data on the number of SEC investigations that are non-public. So not only are we observing the restatements and the AARs, we are observing the amount of effort that is being put forth across the various types of investigative actions, insider trading, financial fraud, issuer disclosure, broker-dealer. And I will say that, accounting fraud and financial disclosure, there seems to be less effort there recently. Now, again, no comment about whether that's a good thing or a bad thing, but there is less effort there. And so that's, we can debate whether that's a good thing or a bad thing, but, that's what the data says.
Let's go next to Jerry.
Great. Have to unmute my phone. Do you hear me yet or no? I'm still trying to unmute. Oh, good. I'm on. Okay, great. Well, thanks very much for the presentation. I really enjoyed all three panelists. It was very good to hear. And as a user of financial statements, mostly on the municipal side, not necessarily on the corporate side, I was actually, Professor Taylor, I was very surprised with the company, which actually had a paragraph on COVID. That was a shocking one. But I guess more importantly, this is more of a comment, and I don't know if you have any thoughts on this, because the SEC, when it comes to municipal securities and initial issuers, it's a very gray area, or maybe a black and white area about whether or not there's regulation. But as a utilizer of financial statements from multi-billion-dollar hospital systems, and even billion-dollar hospital systems, the COVID disclosure is actually less than the beverage company you pointed out. It's zero. And it's just some are great, by the way. Some are actually more expansive than the publicly traded companies, and it's not a whole industry thing, but I'm looking at numbers today for a $1 billion hospital system, and you don't have it, and the government, actually Medicare is advancing funds in advance of Medicare payments, and the question is whether or not that's dead or not. I don't know, maybe JW's got a view on that, but it's just very frustrating to know what the impact of COVID is, and also just what liabilities will remain in place after, once we get past this. And is it debt, not debt? And I've heard it's a gray area, but I think nobody's really treating it as debt, which could be another violation of some disclosure rules. But any thoughts you've given? I know municipal securities, public finance may not be your forte, or an area you spend a lot of time, but I'm just wondering if you have any thoughts on what the SEC, and I'm not looking for enforcement actions, but maybe, the SEC has some guidance on the municipal market, but maybe some enhanced guidance, because there's just, some of these issuers just say absolutely nothing. It's as if nothing happened.
So definitely send me an email after this, because I've been working with some colleagues on municipals, and I find the municipal market just fascinating in the sense that it's not as highly regulated, or does not appear to be as highly regulated, potentially because of enforcement or other issues, as the public issuer market. And so something that we found, which may inform why you're potentially seeing that, is many of the people, looking over the municipal disclosures appear to be relying almost primarily or exclusively on credit ratings. And so there doesn't seem to be, at least what we're observing in the data, a demand from the user side for this sort of granular level detail. But I agree in principle with everything that you just said. It seems shocking to me, or maybe not as shocking, depending on, one's view of 2020. It seems surprising to me that we would have a major event like this, certainly for a hospital system, and that there would be no mention of that within the disclosures. And I do think that does speak to, with the principles-based disclosure system, you do kind of need to set somehow a minimum lower bound on what the threshold is. But definitely, Jerry, follow up with me follow up with me after.
Yeah, Jerry, I would say just one thing. I think it's a fascinating topic. We just haven't had the resources to devote to it. But as someone who's been approached to buy Metro North bonds in the middle of this, but with them providing no disclosure, and they're right outside my window here, I'm like, are you kidding me? It's great they're paying 5% because no one's writing, right? But it is an interesting question, and I completely agree with Dan that it's something, a topic of interest right now as some of these entities really struggle. And what are investors getting other than a note from a broker about a bond?
I can follow up with you on the Metro North, which I assume you're talking about the MTA. And the MTA disclosure has actually been exceptional. And I can tell you where to find that, but they've actually been tremendous. On a 1 to 10, I'd rate them as a 12. I mean, they've been.
Oh, really?
The story isn't great. But and I can help you with that after the call. But they've gotten their act together and some really good disclosure. But there's plenty of them who can do a lot better.
Yeah, that's good to hear because it's not the first thing that you see when they approach you. You have to ask.
Right? No, it's maybe another.
Yeah.
But great.
All right. Any additional questions from any members of the committee, staff? If any of the commissioners have gotten back on by chance, if you've got any questions for our panelists. Okay, hearing none. Let me finish where we began, which is to thank all of our panelists today for taking time out of what could only be described as, I'm sure, busy schedules. As you can see from the robust discussion and questions that the information you provided with us today is extremely valuable as the IAC and the Commission try to tackle some of these issues going forward. So with that, again, thank you very much, and I will turn it back over to Jennifer.
Thank you, Chen, and I will echo your thanks to all of the panelists and the committee members for their questions. Just a really great way to start our discussions today. So at this point, we'll adjourn the morning session, and we will be back at 1:40 for the second public section, talking more about COVID and implications for the next proxy season. Thank you. I'm sorry, I couldn't hear you, Nick. Did you say that we're live now?
Yes, we are.
Okay, thank you so much. Well, we're ready to start our afternoon session for the Investor Advisory Committee meeting. Before we get to the second panel, Adam, I think we had some changes for the roll call. So I understand that Joanne Yu has joined us and Sandy Peters had to drop off. Are you able to make those changes to the roll call, Adam?
Not a problem. I've made those changes. Thank you, Jennifer.
Great, thank you. Well, I'm going to pass the baton then to Paul Mahoney, who's going to moderate our afternoon panel on COVID-19 implications for the next proxy season.
Thank you very much, Jennifer. We have a wonderful set of panelists. I will introduce them briefly in the order in which they will speak. First, Matt DiGiuseppe, who is the Vice President of the Asset Stewardship Team for State Street Global Advisors. In that role, his team is responsible for developing and implementing the firm's global proxy voting policies. He also serves as a member of State Street Global Advisors' Global Proxy Review Committee. We also have Professor Colleen Honigsberg from Stanford Law School. Professor Honigsberg is trained in both law and accounting. She has worked as an accountant for PricewaterhouseCoopers and served as a senior economic research fellow with the Public Company Accounting Oversight Board. I can also say as a fellow academic that she has done really outstanding work at the intersection of law, accounting, and finance. And then finally, Darla Stuckey, who is the president and CEO of the Society for Corporate Governance. Before that, she served as Senior Assistant Secretary at American Express and also was the Corporate Secretary at the New York Stock Exchange. So we have panelists with a remarkable array of experience and knowledge, and I look forward to hearing them. They will speak for about 10 minutes. If I could ask IAC members, it seemed that the chat function worked pretty well in our last session. So if you have, if you want to ask a question, just put that in the chat, and we will get to you. And I will turn it over to Matt.
Well, good afternoon, and thanks, Paul. As Paul mentioned, my name is Matt DiGiuseppe, and I'm a member of the State Street Global Advisors Asset Stewardship Team. And before I get deep into it, I'll just look for a nod from someone that you can hear me okay. Excellent. I'm seeing nods, yes. State Street Global Advisors is the investment management arm of State Street Corporation. With approximately $3 trillion in assets under management, SSGA is the world's third largest asset manager. As a fiduciary, State Street Global Advisors must act in the best interest of our clients, an obligation that extends to the stewardship activity we undertake on our clients' behalf. As a long-term investor in more than 10,000 public companies across the world, State Street Global Advisors believes that asset stewardship is an important tool in driving long-term shareholder value for our clients. Today, I'm going to discuss our views on executive compensation for the upcoming 2021 proxy season. I'll begin by providing an overview of some of the challenges that we believe companies will face. Next, I'll provide a set of expectations that we've laid out for companies to support our informed voting in the current environment. And then finally, I'll discuss some actions related to long-term equity grants that we hope companies will avoid. Executive compensation is a perennial engagement topic for our team, driven both by the annual vote that we're familiar with and the deep connection to a company's strategy. We believe that an executive compensation presents both risks, creating potentially perverse incentives, as well as opportunities. And when structured appropriately, exec comp can be well aligned with the operational goals and shareholder results. However, executive compensation is receiving elevated attention because of the COVID-19 pandemic. Directly, the economic fallout from the pandemic could render many compensation-linked performance targets simply unattainable. Indirectly, the pandemic highlighted many aspects of executive compensation that cannot be captured quantitatively. As such, many of the best laid plans to align executive compensation performance may be muted as we reach the end of the calendar year. Further complicating the issue is that the impact of COVID-19 is not uniform across businesses. Some boards will need to consider the applicability of an executive's performance against predefined goals, as well as the relevance of executives' decisions to pursue layoffs, furloughs, and other extreme cost-cutting measures in the face of a crisis. Conversely, other boards may need to weigh dramatically improved near-term performance against the sustainability of such results in a post-pandemic world. In other cases, boards may need to look closely at any adjustments to performance measures to account for the unusual circumstances they face. We recognize that it's common for companies to use non-GAAP metrics to assess performance. And it's also reasonable to expect that this practice may increase along with the use of discretion by the board. For instance, there is no GAAP measure for performance during a crisis. However, simply relying on the same set of adjustments to financial measures that have always been used, such as the backing out of the impact of extraordinary events, like, say, a government-mandated shutdown of the business, without attention and consideration to the magnitude of the adjustments, could result in executive compensation outcomes that do not match the experiences of the broader employee base. Which brings me to my second topic today, disclosure matters. Because the pandemic means that most companies will find themselves in unique circumstances, we intend to rely on our case-by-case approach to voting on executive compensation, evaluating each board's decisions and the specific circumstances of each company. As such, enhanced disclosure of the board's decision-making process will be key to our evaluation and voting. We'll continue to expect clear, concise, plain English disclosure of executive compensation and how it's aligned with the company's strategy. And where boards elect to use discretion in making award determinations, we'll focus on the disclosure and narrative describing the board's decision-making process. We've always asked our portfolio companies to use discretion in their compensation programs. However, as the proportion of pay awarded based on qualitative or discretionary assessments increases, so do our expectations for detailed disclosure. And we anticipate heightened investor scrutiny around such discretionary decisions because of the pandemic and the breadth of companies that have been impacted. That said, a well-executed discretionary element of the annual bonus program provides an opportunity to communicate how a company has performed on non-financial priorities that are foundational to the strategy. The compensation discussion and analysis portion of the proxy is an important opportunity for companies to communicate with their shareholders about the short and long-term performance priorities. This form of communication is only elevated and become even more important when a company has pulled its financial guidance, as many have. Further, we hope companies will include the following sort of details in their disclosure. As I've said, first and foremost, a deep explicit alignment between the compensation program and the current strategy. A well-structured compensation program should be an extension of the strategy that rewards executives for successful execution. We also would like to see clear disclosure of performance against expectations, including how and why expectations may have changed materially in reaction to the pandemic, and how payout opportunities have been adjusted alongside changes in performance expectations. For instance, were target payouts lowered to match lowered expectations, or were payouts capped because of lowered performance targets? And finally, we really want to understand how executive compensation decisions, including the adjustments to performance goals, align with changes to compensation at the company more broadly, including potentially layoffs and furloughs. To this point, my comments have largely focused on short-term performance considerations as they relate to executive compensation. I'd like to spend a moment discussing long-term equity compensation, which has also received significant attention because of market volatility. This is not surprising, as equity compensation represents an increasing larger proportion of executive pay. Shareholders may allow the dilution and expense of equity grants in order to more closely align executives and employees with the shareholder interests over the long term. And though the impact of COVID-19 is currently short-term, although it may feel like 5 years, it hasn't even been a full year yet, we already have observed companies taking actions with respect to their long-term compensation programs. And so it's worthwhile sort of stating the things that we would like companies to avoid. Those include making retention awards that do not have a longer vesting period than the company's normal equity grants. That's not to say that attraction and retention are not key aspects of any compensation program. However, as companies are thinking about special retention grants, we'd like them to consider that they have sufficiently long vesting periods to benefit shareholders. Replacing or replacing underwater options or making grants to replace options that expired out of the money this spring would also be something that we'd like companies to think about. And finally, timing off-cycle equity grants to the bottom of the market or changing equity structures, such as increasing the proportion of stock options to take advantage of volatility, are things that will attract a critical eye. However, at the end of the day, we share a common goal with our portfolio companies, seeking long-term returns. We recognize that compensation committees and boards will have to make many difficult decisions in the coming months. Many of our concerns can be addressed, as I've said, through clear, fulsome disclosure, and engagement is always an option for us when we discuss the most complicated cases. At State Street Global Advisors, we seek to be transparent with our views. And absent direct engagement, there are also substantial resources available on the asset stewardship section of the ssga.com website. I look forward to answering any questions that you may have following the presentations of my other panelists.
Matt, thank you very much. Colleen?
So I think I'm going to follow Matt, and can I make sure that you guys can hear me? Could somebody nod? Maybe, can anyone hear me? If so, would you be able to nod? Yes. Okay, great. So with that in mind, so thank you very much for, inviting me to present here today. Really excited, and I hope that what I have to say is actually helpful. So I think Nick is going to put my PowerPoint presentation up. So Nick, thank you very much. And then on to the next. As Paul mentioned, I'm an associate professor of law at Stanford Law. I also have a PhD in bookkeeping, as my mom says, in accounting. So what I wanted to talk about today is, COVID and accounting. And in particular, there are three issues that I want to touch on. So first, non-GAAP. Second, internal controls and a remote work environment. And third, going concerns. So with that, Nick, could you move to the first slide? Thank you. All right, so just as a little bit of background, it's not clear to me that when we're dealing with non-GAAP reporting, that COVID is raising a lot of new issues that we haven't thought about before. We've been dealing with non-GAAP and thinking about it for decades. So I think though COVID does highlight some of the pre-existing concerns that people have had. So, when COVID started, I think there was this fear that we would get this explosion of so-called EBITDA. This is a mug that is actually for sale on Amazon. And it's earnings before interest, tax, depreciation, amortization, and coronavirus. Now, this was made a bunch of headlines and a bunch of mugs. We haven't really seen companies actually adopting it. But I think it's important to note, it's not that companies wouldn't have to put coronavirus as a separate adjustment for the impact of COVID to actually hit non-GAAP numbers. So I think it's Matt touched upon this briefly, a lot of the common adjustments that we've seen, things like goodwill impairment, things like write-downs, have really skyrocketed during COVID. Now, when you're starting with a GAAP number, and then you're making all of those adjustments to get to the non-GAAP, and if the size of those adjustments are increasing in magnitude, as many of them are, then the distance between the GAAP and the non-GAAP number is correspondingly going to increase as well. So to give you a little bit of a scale of the magnitude of some of these increases, Nick, could you go to the next slide, please? So this here is just data from CapIQ. It's just looking at, here are total value of impairments, write-downs of other assets beyond goodwill, and then special items for the first 9 months of each year from 2017 through 2020. Now, what I want to focus on here is less the absolute value of that number, but more the sort of increase in the percentage. So those black bars right there, that's 2020. And let's take goodwill. So we're starting off with here is total value of like all goodwill impairments from in the first 9 months of 2020. And, you know, when you look at like the 2019 numbers versus the 2020 numbers, you can see the value of goodwill has more than doubled. The value of goodwill impairments has more than doubled. When you look at write-downs, like also you see that huge percentage increase. And then when we look at special items, again, you're seeing that huge increase. So, and special items are these sort of, you know, one-time charges, things like restructuring, legal, but can also include things like, you know, goodwill or write-downs. So there is some double counting there, just FYI. But I think the thing to focus on here is really the increase in magnitude of these common non-GAAP adjustments. And so if these non-GAAP adjustments are, you know, really increasing, we're also going to see just a far greater increase in, you know, the gap between the GAAP number and then the non-GAAP number. Nick, could you go to the next slide? Thanks. Yeah, so with this, I just want to kind of go through, here's an example of the adjusted EBITDA. This is from ADT's most recent 10Q. And then, so we're going to start off with the net loss. This is that GAAP number. We're going to go through all of those different adjustments, and then we're going to get down to adjusted EBITDA. So you could see like there's goodwill impairment on here. They didn't have any for 2020, but if they did, we would have added that back in, thus increasing the distance between those two numbers. Now, one thing, you know, the issue with non-GAAP is like always and conceptually, does this information sort of, do companies provide this to sort of obfuscate poor earnings and confuse investors, or does this provide some really like valuable source of information for investors? And this seems to be like the overarching question. There's obviously a lot of academic literature on this, and for what it's worth, you know, you can find evidence in favor of both arguments, but for the most part, the academic literature seems to be pretty positive about non-GAAP and does suggest that it really provides a valuable source of information for investors. With that said, the academic literature does also highlight the difference between these sort of transitory one-time adjustments, hopefully something like a goodwill impairment, versus those types of recurring adjustments, something like depreciation or stock-based compensation that you're just going to have every year. And with this in mind, you know, one proposal that you do see in academic literature and that I think might be helpful for investors as they're really processing these non-GAAP numbers, you know, especially in a year like this, where presumably we're going to have a lot of those one-time, you know, sort of transitory adjustments, would be to ask companies to sort of separate, here are these sort of recurring investments, here are the non-recurring investments. You know, just makes it a little bit easier to identify what's going to be persistent and what's a sort of one-time, you know, adjustment. So next, if you could go to the next slide, please. So the next topic that I wanted to hit on was COVID and internal controls. This figure here is taken from Audit Analytics, and it just looks at the SOX 302 disclosures, the number of such 302 disclosures, and the number of those 302 disclosures that are actually referencing COVID and a remote work environment. As you can see, and probably to no one's surprise, we've seen an increase in the number of disclosures that have referenced the challenges that are being posed by COVID-19. The most recent month in which there's data is August, and about 14% of the disclosures in August did reference, you know, some of the challenges that companies are facing. Now, if anything, I'm surprised it's not higher, because as you can imagine, like you have a remote work environment that's going to cause you to rethink internal controls in many situations. Just to take a very like stereotypical sort of simplified example, imagine you have a company, you have three different, you know, the accounting sort of finance function has three people. You have the controller who reconciles the general ledger, and then you have two staff accountants who both have editing functions and are allowed to actually post and make edits to that general ledger. Well, standard segregation of duties, you don't want the person who's actually reconciling that ledger, the controller, to also be able to edit the ledger. Well, now COVID hits. Perhaps you had to lay off one of the staff accountants. Or perhaps one of the staff accountants is now working at normal hours. Maybe they're working at night because they have a kid to take care of during the day. Well, you know, because of these logistical issues, you think, oh, we'll give the controller, you know, the ability to also edit the ledger. Well, now you're going to have an internal control issue because you're going to have segregation of duties concerns because all of a sudden, like the person who's reconciling that ledger also has the ability to edit it. You know, as a fun fact, if you ever look at filings for SPACs, This is why so many of them have material weaknesses, and it's because their finance function is one person. So with this in mind, if you could go to the next slide, Nick. If you could go to the next, thank you. So I do want to mention a couple and specifically highlight some of the disclosures that we're seeing. And I think these are reflective of common sort of internal control concerns given the remote work environment. First, we have Home Depot. They say during the second quarter of fiscal 2020, we temporarily suspended physical inventory counts in our stores as a result of COVID-19. Next, Artsway Manufacturing. If our workforce continues to decrease due to COVID-19, we may experience difficulties maintaining proper segregation of duties due to the limited number of staff we're able to keep working. So that would be like the example that I just mentioned. Third, Honeywell. Most of our employees worked remotely during the period in which we prepared these financial statements due to the impact of COVID-19. We enhanced our oversight and monitoring during the close and reporting process, including investments in expanded VPN capabilities and higher scrutiny and monitoring of cybersecurity threats. Well, no surprise if you have a bunch of employees working at home using their personal connections, personal cell phones, you're going to have concerns regarding cybersecurity. One thing I also want to sort of mention here is I'm an accountant. I think internal controls are important. I think when you think about like the whole reporting system, we have these sort of internal processes, software and internal controls really designed to generate high quality data. And then we have these sort of external functions like auditing, designed to really like review that hopefully already high quality data. Given perhaps concerns with remote work and internal controls, this should be interpreted in light of the fact that, many of the audits we're going to have this year are also going to be remote. And, one concern is that you may have weaknesses both in that remote audit and in the sort of internal controls and remote work in the same area. So, for example, consider inventory. Like like Home Depot, maybe they can't do their normal inventory procedures because of remote work. Well, then the auditor is going to come in. Chances are, the auditor is also likely to not do their their standard procedures because they're probably not going to go to the warehouse and count the inventory this year in the same way they've done in the past. So this is something perhaps we'll see more about this in sort of the CAM disclosures, but hopefully that, we can provide some guidance on and help to make sure that we're not having weaknesses in the same areas of the financials in both the internal controls and those external audits. And then finally, I know I'm just about out of time. If you could go just to the next slide. Thank you. I just really want to briefly discuss COVID and going concerns. For what it's worth thus far, I haven't found evidence that we've seen an increasing number of going concern modifications relative to the total audited opinions for 2020. So, I've just looked at this very basically, I haven't seen it. Now, there are a number of companies, maybe 60, 70, 80 or so that have filed going concern modifications, and those modifications have referenced COVID-19. But bear in mind, most of those companies have previously filed going concern modifications. They're doing it again this year for the second or third time. So I think one explanation for why we haven't seen this sort of skyrocketing number of going concerns, which I think was a fear early on in COVID, is just bear in mind the going concerns are forward-looking. So it's like, the auditor's prediction over what will happen over the next 12 months, whereas the audit opinions are going to be, looking backwards over the past 12 months. So hopefully, given that, we'll have mass vaccinations relatively soon, and by the time the auditors are really looking at all those, 2020 fiscal quarter, fiscal year-end companies and doing the 2021 audits, we'll have some reason for optimism in the next 12 months. Will look better, and we won't see that sort of skyrocketing number of going concerns. With that being said, of course, you got to interpret the available data in line with the limitations. We don't have data for the full year. And of course, many of the companies that do file those going concerns, it's going to be a little bit delayed. And so it's possible that those filings are delayed, and that's why they're not showing up yet. But, whatever the case, doesn't seem to be that they are showing up yet. So, hopefully some reason for optimism. And with that, I'm done. So thank you.
Any questions?
Colleen, thank you. Darla.
Hi. I'm hoping, let me set my timer. Thank you all. Thank you, Paul, for inviting me to participate, and thank you all for being on. Good afternoon. I'm participating on behalf of the Society for Corporate Governance, founded in 1946. We're 75 years old. We are a professional membership association of approximately 3,400 corporate secretaries, assistant secretaries, in-house counsel, outside counsel, and other governance professionals. We serve about 1,000 public companies of every size, and our members are responsible for supporting the work of their corporate boards of directors and their management teams. And primarily, as you can imagine, their duties are corporate governance and disclosure matters. Our vision is to create long-term shareholder value through better governance. We do this through education primarily. So we're happy to be here. Today, I would like to speak about 3 areas, basically proxy plumbing generally, but very specifically virtual shareholder meetings and the experience we had this year and the work being done to date to enhance the experience going forward. Also some of the work being done on NOBO-OVO and also proxy fees. Now, these topics are directly sort of related to COVID because of the virtual nature of annual meetings. I had also thought I might talk about disclosure of board diversity and maybe 10b5-1 plans. I can take questions if you want, but I don't think I'm going to have enough time. I went too deep on the other things. So you can also stop me if you get too bored. But in any event, to the governance nerds that are on the call, and I actually count Matt as one of those with us since he's on one of our working groups. The virtual shareholder meeting this year was quite important to us, and so I'm going to start there. The other proxy plumbing working groups that came about as a result of the November 2018 roundtable were NOBO-OVO, end-to-end vote confirmation, proxy fees, universal proxy, and what I forgot the name, future technology, but basically blockchain. All of those groups have had meetings, to my knowledge, except for the future technology one. Let me jump right into virtual meetings. As you know, the most notable change this year from our standpoint in the corporate community this spring was the virtual meeting season, or the annual meeting season. The lockdown, curtailment of travel, social distancing basically resulted in most companies having to hold virtual meetings for the first time. About 2,500 were held this year, as opposed to 300 in all of 2019. And that's important for you to remember because, if you're a service provider and you're used to providing, for the last 10 years, anywhere from 100 to 300 virtual meetings, and all of a sudden you've got 2,500 companies coming at you, that's quite something. So great magnitude. But depending on who you ask, we think the season was successful and that most meetings were held successfully. From the company's point of view, by and large, they were relieved. They were happy for the technology and the service providers who provided it. It largely worked. They were thankful for the guidance of the staff accommodating changes to the notice requirements for virtual meetings, because many of these people were caught right in the middle. They had already filed their proxies or were soon to file their proxies when they had to change. So we're very appreciative of that. And there were a few hiccups, which we'll talk about later, but by and large, it went well. And we owe everyone a debt of gratitude. I have lots of funny anecdotes, but as you can imagine, if any of you know the movie Broadcast News, I may be dating myself, but the Holly Hunter character in Broadcast News is how many of our corporate secretaries felt the day of the meeting and probably the weeks leading up and then after the fact, the whole crying jag and the pulling your hair out and orchestrating from behind the scenes with, again, it wasn't just that the investors were remotely listening in. It was that every single board member was in a different place. Your chair was in a different place. Your CEO was in a different place. You probably couldn't even be in the same room with your general counsel. So it was very, very difficult. But in any event, I won't go on there. The companies also appreciated the accommodation by the states. I know this is not an issue for you guys, but the state laws, there are certain states that don't even allow them. Some issued executive orders to allow virtual meetings. We hope those go forward. As companies are now planning for the next year, 2 or 3 months ago, I would have said something different, but now it seems like, I'm happy for the vaccine, but it seems like we're not going to be in a place where people are going to feel comfortable with large gatherings in the spring. So I'm guessing the the bulk of the season will, once again, the companies will undertake virtual shareholder meetings. This year, they will be smoother. The disclosure, particularly the disclosure around how to get in and to the meeting and how you can participate in the meeting will be better this year and easier this year based on some fixes that we're doing. So as soon as the proxy season ended, best practices group was established this summer, co-chaired by me and Amy Boris, the CEO of CII, facilitated by Doug Rutgers, and to outline expectations as well as evolving practices. The group did not take a position on whether the company should hold a VSM, but it highlights certain areas of the experience and what we call evolving practices and sort of standard practices. Matt was on that group. It was an excellent group. We had an equal number of issuers and investors, and we did not, they basically did the work. We did not have the people with the commercial interests involved in setting kind of the guidelines. We did have a group of oversight people who were proxy service providers and other interested people that made some edits, but the lion's share of the work was done by the issuers and the investors. And I want to give a few highlights. Basically, investors were once skeptical that VSMs were a very poor substitute for in-person meetings. I think safe to say they've softened their view. Universally praised by both investors and issuers was that the number of shareholders who could attend virtual meetings greatly increased. You could, as an investor, you could attend more meetings and, more than one in a day, given that you didn't have to travel. So that was a great thing, and the two companies agreed. Less praise was the fact that all meetings, or almost all meetings, were audio only. And safe to say that investors wanted to see the company representatives, and they didn't. It wasn't like this. The working group tackled that. Both sides were very candid about the pros and cons. One thing I will say, the technology last year wasn't there yet. I don't think the providers had the bandwidth to do audio meetings, particularly given the huge number and the quick, turnaround, the quick uptake. So we do think this will evolve, and we do think that providers might be able to do some of this next year, but it remains to be seen whether companies are really ready to put their boards on what is in effect a Zoom annual meeting from their living rooms. So unless they can all be together in the same room, I don't know that we're going to see that, but that was something that was discussed and is in the report. So the guiding principles of the group were that broad investor participation should be valued and encouraged. Meetings should promote equitable and equal treatment of investor participants. Opportunities for meaningful engagement between investors and board should be provided. And issuers should communicate the benefits of the virtual meeting to shareholders. We did try to replicate the in-person meeting as closely as possible where we could. So a couple other areas where the best practices group weighed in that were kind of, bugaboos were the presentation of proposals and the general Q&A period. So there is skepticism that, companies cherry pick questions, don't take all the questions, shorten the time period. And then again, there were some problems with some shareholder proponents maybe not getting access that they thought, or not being able to choose how they wanted to present their proposals. So again, we dealt with those. We came up with some best practices, I would say, to facilitate shareholder proponents. You should provide and encourage a proponent to call in on a dedicated line. Tell the proponent how much time they're going to actually have to read their proposal, and what happens when they're done speaking. Like, does somebody say okay and cut them off, or do they get to say some follow-up or not? Because I think that was an issue. We need to ensure that the proponent can hear the chair and be heard throughout, and also ensure that any pre-recorded or written remarks that are read on their behalf or played on their behalf have the same sound quality. Some of these are very much in the weeds, but you would be amazed at, sort of the technical problems. These virtual meetings were dependent really on people's internet connections, just like us on this call today. So we talked about all those things. Proponents should also, on their side, should adhere to the rules of order and be cooperative with the issuers. So that was something we discussed. The report also contains a list of practices for relating to Q&A. Again, I'm not going to go through them all because I don't want to steal the whole thunder. This report should come out very soon, and I hope all of you read it, hopefully next week. But things that came up in the Q&A session, again, how much time is allotted? Which order would the question be taken? Can you ask questions in advance? Will the question be read verbatim? Can a shareholder ask more than one question? How many follow-ups? And then on the corporate side, there was an issue about not necessarily knowing who was asking the question. I'll stop there. I'm going to move on. Hopefully you will indulge me for a few more minutes, because one of the other big things that came out of the virtual meetings was this lack of access. And I'm here to report to you that our end-to-end vote confirmation working group has taken up the issue of access to annual meetings. And we did that because we have all the providers in the room talking to each other, that being Broadridge, ComputerShare, Equinity, and Mediant. And so the upshot of that is, if you were a beneficial owner trying to get into a meeting with a Broadridge control number and Broadridge was not hosting that meeting, if ComputerShare or if ComputerShare or Equinity were hosting, your control number would not work. And you would have to go get a legal proxy from your broker. That could take 3 days. So you would not be able to get into a shareholder meeting when you wanted to. And this caused some consternation. So the people in the end-to-end end-to-end confirmation working group have decided to try to fix this, and Broadridge has come up with an application programming interface, which is called an API. Many of you may know that. I did not. But they're going to basically provide a control number that can be used. They're going to give it to the shareholder via email, and that shareholder can use it into the meeting with the other platform. And if they want to vote, there's a separate API for voting. But in any event, they'll be able to get in. And we expect a March 1 deployment on this. So that should work, and we're hopeful. I don't know. I guess I should stop there. I was going to talk about fees, because the issuers have seen an increase in fees due to managed accounts, and also due to what I would call as the Robin Hood effect. So if anybody wants to know about that, feel free to ask me. We've also done a lot of work on end-to-end vote confirmation and sort of parsing out what the issues are when there's over voting, or what should I say, over reporting. And we did a pilot, so there's some interesting data on that. But I will stop there and just say thanks again. And going forward, I hope that the focus on proxy plumbing issues can remain with the new administration, certainly with this group, because it is sort of the nuts and bolts of the system, and we're happy to have a seat at that table. Thank you.
Darla, thank you very much. So we are now going to turn to Q&A. First, let me just check and see if there are any commissioners who are on the phone who would like to ask a question.
And Paul, this is Jennifer. I just want to note that Nancy Lamond has joined the meeting too, and Adam will mark her present.
Welcome, Nancy. All right, so let's go to JW.
Oh, okay. So I have a quick question for Professor Honigsberg. A question and a pontification. One of the results of COVID is it's been a spur to, crisis is a spur to innovation, right? COVID has innovated in remote technologies across industries that have had to deal with this, that have put off dealing with remote focused innovation. Probably no less true in the auditing profession. I think you've got internal auditors investing maybe in some of the distributed ledger technology that could make internal controls more readily verifiable, more difficult to defraud. You've got auditors now investing in techniques for, don't pretend to understand all of them, but techniques for remote auditing of inventory. To what extent can this continue? To what extent can PCAOB encourage it and make sure not to get in the way of it? Part of why I think this is so exciting is that the more you decrease the economies of scale, the less consolidation I think you're going to have in the auditing profession. And, the Big Four have told us it's all economies of scale. That's why we dominate. The more that changes, I think it would be exciting to see more competition from the rest of the Big Ten, at least, with the Big Four. And that could be something that COVID can help to spur. So is that a reasonable expectation for the future? What's the role for PCAOB in this? Sort of welcome your thoughts just specifically about these innovations in auditing and just sort of the future and the PCAOB's role in all of that. Thank you.
Yeah. So first, hi. Great to see you. And, I think it's a great question. I can't even pretend to give you a full, thorough answer because I think so much of it is unknown. I would start with, so do we think this sort of increase in technology and like all the developments that are, going to happen and are already happening, and sort of the auditors, changing the standards and like clarifying standards to, encourage the use of this technology and to say that we can rely on it? Will that affect sort of the market concentration? I think there's actually, I think I could make an argument for why we would see actually greater concentration in the big four. I think I can make an argument for why we would see no effect. And I think I can make an argument for why it would lead to greater dispersion. In terms of like sort of greater concentration, I know there's some theoretical work in accounting about this, and basically says, we haven't had like a really good empirical shock and really good empirical evidence, but the theoretical work sort of says the big four are going to invest the most in this technology, and so they're going to be the leaders in it. And if you have those high fixed costs, that they are going to be the ones who sort of purchase it and use it and learn it and train in it. And then the smaller auditors are going to catch up, and it's just going to sort of, exacerbate the concentration. I think there's an argument that it would have no effect, which is basically the argument that we have an oligopoly. We don't have like a real free market in this area. And 30 years ago, we used to see that when you had an accounting scandal, clients would leave that big four and go to somebody else. In the US today, when we run that same study, we don't see that same effect. When you run that study in other countries, sometimes people do, but they don't do it, but they don't. Like even, my understanding is even like the KPMG PCAOB scandal didn't result in an exodus of audit clients. So, whether they're competing on audit quality from the shareholders' perspective, it's not clear from the literature that that's like really what's driving the market. And it seems like some of these other factors, certainly client satisfaction matters. Certainly, the reputation of the firm matters. The firm's intermediaries, like the bankers and stuff, all of that matters. But it doesn't seem like it's that sort of traditional market where they're really competing on price and the quality that's given to the shareholders. So I think there's an argument that it would really have no effect on concentration. There's also the more optimistic argument, which is where I think you're going and where we can hope for that, the technology sort of levels the playing field and, reduces, we have better economies of scale, and that we do see, greater, dispersion. My guess, honestly, is that we're not going to see any change, but, I think it's an empirical question. For what the PCAOB can do to encourage it, that's a great question. I think the underlying question is, to what degree do they want to encourage it? And my guess is that, when you've seen increases in technology in this area, there's always, a little bit of pushback. And the question of do we really want to adopt this widespread? Is it just a mass experiment for 1 year that's going to result in problems? We may not have that choice this year. And so I think, just clarifying under the auditing standards, what is acceptable and what is not, would be, and is the easiest sort of first place to start. Sorry, I don't know if that answered your question.
No, it's something we're going to have to keep talking about, I think. But one small question. I noticed that they released guidance yesterday. PCAOB released guidance yesterday, indicating that they've paid a lot more attention in inspections to interim reviews of quarterly. Just the analytical procedures. I was curious. I wondered why they weren't doing that before. I mean, quarterlies are important. Why that seems like something they should have always been doing. What do you think about that? What are the analytical procedures they should be focusing on? And should we make that a permanent part of the inspection regime going forward?
It's a great question too. And my first instinct again is that's an empirical question. I think the PCAOB has that research arm, and I'm guessing they're already, hopefully when they design those interim reviews, they did it in such a way to set up that, here we're going to have some random, assignment. We're going to do this in such a way that like we can actually better study the effects. And they do have a strong research arm, and historically they have. And so hopefully they're actually studying this. And, again, I would just say whether they should adopt it or not, it should, and whether it should become a permanent part of the process really depends on what those studies show. And, I would leave it at that. As to what they should focus on, again, I think there really needs to be more focus on like, what are the major issues that are going to come out with remote auditing? And, there are obviously some that like come to mind. You mentioned, inventory counts and like the new technology in that area. Yeah, that's an obvious one that comes to mind. We should, better study that, focus on that, consider that. Other ones that come to mind, I know there's some behavioral literature about like Zoom conversations and whether people can pick up on those kind of cues and, the relationship that like the auditor has when talking with management. And that, people can't pick up quite as well, at least not yet, to those sort of personal connections and, behavioral cues over Zoom the way as well as they can in person. So I think that would be like another area that we would want to think about a little bit more. And then, going back to internal controls, like, it's going to be hard to test some of those when you're doing a remote audit, or at least harder than usual. So I would start just really theorizing, like, what are the major issues that we're going to have with remote audit, and thinking about that, and then design the procedures around that.
Thank you. Heidi Stam has a question.
Thank you, Paul, and thank you to all the panelists. Very interesting conversation. I think, as many of you know, that one of our subcommittees is very well focused on the proxy plumbing issues that the Commission has been tackling for quite some time, and I was very encouraged to hear Darla talk about that, and I'm especially interested in this report that she's referred to. I think it'll be very instructive for our subcommittee, so I look forward to seeing that. You did mention that you were going to comment on the fee issues that are associated with the proxy plumbing issues, and this is a topic that has been extremely important, I think, to the committee, also to the Commission. Just this week, when we were talking with Commissioner Roisman, he expressed his concern that this aspect of the proxy plumbing issue has been frustrating and difficult to get to the heart of. So, number one, Darla, would you mind speaking to the fee issue that you alluded to but didn't quite have enough time to cover? And then, very importantly, do you see a regulatory path to improving that situation?
Thank you so much for giving me the opportunity. So fees haven't been looked at for, I think, since, was it 13 perhaps, when the last Proxy Fee Advisory Committee, PFAC as we call it, set new fees. What we're seeing, and this comes from our members, and I think it's a result of COVID in a way, because indirectly, people are very much scrutinizing their bills this year. And for the last couple of years, this has been happening, but this year more dramatically. Managed accounts, the number of managed accounts has increased. So the bill, and we've looked at a few bills, and the few that we've looked at, they've gone up in 2 years. They've gone up 140%. So there is a fee associated with the managed account. It's by account, not by individual. I, for example, have 3 managed accounts at one broker. So, but the fees are charged at the account level, and there are just a proliferation of them. At the same time, the issuers tell us that their outstanding share numbers are lower. So they don't have any more shares outstanding, but they're actually paying more fees to deliver these proxy materials. And the other thing that's problematic is that we believe, we don't know for sure, but most managed accounts are voted by the manager. Now, I think you can ask to get your vote back, but I think most of them are managed by the broker. So the person, you're paying for an account or multiple accounts from a single holder when the advisor is probably voting. And so it seems like a real windfall to the service providers and to the brokers that, get reimbursed. and at the expense of the issuer. So it's something we think it should be looked at. It was dealt with. It was, I think, contentious in 2013. There was a fee that was 32 cents. It got cut to 16 cents as an accommodation, I think. But we need to look again at, how those, is it the case, in fact, that all the managers are voting? Because if that's the case, then why don't you pay to send one set to them, one set of materials? So that's, I would say that's not particularly COVID related, but it's like a structural issue. And I think managed accounts are probably superior to commission accounts, and people are opening them. But, we just need to deal with that. And then the other issue is that some companies, again, I think in industries that were hit particularly hard in the spring by COVID, at the time when they, their record date, their share prices were low, and you have people sitting at home trading. As you know, the market was going up, and there are facilities for people to, to get new, younger people in the market, and by trading with, opening accounts with small numbers of shares. So there were just a lot more a lot more accounts, not necessarily managed accounts, but other accounts with small amounts of shares. And again, going back to that proxy fee schedule, you don't have to pay a fee for any account less than 5 shares, but still their fees had gone up dramatically for those kind of accounts that were in places like Robinhood, for example. I'm not trying to pick on Robinhood, but, and that seems to be a kind of a COVID related thing. People, sitting at home trading, if that's really indeed what's happening to the market. So those are the two things. The society is going to try to, we are going to survey our members soon about their fee experience generally, and see whether it's gone up or, because again, we've gotten a few people that have called us and talked to this in depth, but we don't have a broad view of it yet. But we're happy to be in front of anybody that wants to talk about it. I think you asked about a regulatory path going forward. Very interestingly, found out recently that the New York Stock Exchange filed a petition to get out of the fee setting business just a couple of weeks ago, in favor of the FINRA fee schedule, which apparently is identical. But it seems like if we're going to, put together another fee working group, it would have to be under FINRA's auspices, unless the SEC wants to take it up, or another group. I have the unique position of having been at the New York Stock Exchange when we oversaw those fees years and years ago. And I know the NYSE didn't really want to be in the fee setting business. So it would be nice if the SEC would take that. I'm not sure they want to be in the fee setting business either, but we would like that to maybe see that happen.
Thank you very much. It's a really important issue because I think ultimately it's the investors who are paying for these.
Yes, I was going to say.
It's coming right out of their returns, and it's definitely a problem. So I hope if FINRA does take it on, that they'll be able to move the dial on this in some way. Thank you very much.
Thank you. Ted Daniels.
Yeah, just a follow-up question associated with proxy farming dollar. I was interested to know, is there, what you've seen so far, is there any particular step that could be removed to reduce the cost of proxy plumbing? I know you're going to do a survey later, but do you have any initial thoughts on what should take place?
On the fee question?
Yes.
Yeah, you could change the managed fee schedule. If the fees are set, and when they went through the process last year, again, Broadridge has its expenses and is trying to get covered, so to speak. And so there's a bit of an accommodation, and it's a balance. So I think maybe it's just time to kind of recalculate that balance. I also think that the part I didn't get to speak about, the Novo Obo group, non-objecting beneficial owner, no objecting beneficial owner part of the group, there's a lot of talk in that committee about making communications with shareholders more simple. Companies want to talk to them directly via email. Right now, you have to go through all the intermediaries. That's the expense, going through the intermediaries. We'd like to simplify that. Again, there are a lot of commercial interests that are entrenched, so it's not an easy task, but we're doing work in that group as well. And that group is run by Katie Sepchik. She is working on, again, a report to set forth where everybody's positions are, the brokers, the institutional investors, the mutual funds. The mutual funds actually have the same fee issue on managed accounts that the corporates do. So they're interested in that as well. But there's a lot of work being done. It's not going to be easy, but just basically going back and looking at has the technology helped? Because some of these fees, to me, it's a little bit like I don't want to be derogatory, but it's a little bit like toll booths and tolls. You know, when you're going to build a highway, you charge tolls to defray the cost of the highway. And then it's 30 years later and you're still going through the toll booth and you wonder, well, this road's done and yeah, they have to resurface it, but do they still need this money? So in my mind, that's how I think of it. But I think it's something that should be looked at. And because it is a time that, again, it's a COVID issue because people, companies are stressed they're looking at their costs, now more than ever, this spring more than ever. And the fact that it came out of the blue, they try to, again, corporate secretaries, it's their budget. They're trying, they know how much they spend on proxy voting pretty much year over year. It's been pretty static. And then all of a sudden it skyrockets in one play, with managed accounts, and they didn't know it was coming, and that's the other thing that was problematic. So I hope that helped. But
Ted, I think you're muted.
If you were to take one step out of the process of proxy voting, which step do you think would get the greatest pushback?
Wow, the Novo, changing Novo Obo would get the biggest pushback because brokers have a very keen sense of the privacy issues for their clients, and they're very proprietary about their clients. They don't want to share their clients with the issuers or anybody else. So they have relationships with the providers and the intermediaries, Broadridge or Media, primarily Broadridge, and they don't want to change that. So that would receive the most pushback. I think the simplest thing would be to look at the fees, maybe give some relief that way.
Okay, thank you.
Thank you. Rick Fleming.
Thank you. My question is also for Darla. Actually, I'll start with a comment, and that is, as you were going through your presentation, I think you were ticking off all of the concerns that I've heard from shareholders about remote meetings. So thanks for addressing such a broad array of issues. And I'm also looking forward to this report that you're about to put out. Concerns around the ability to participate in the Q&A and sort of engage during the meeting, I think, have been expressed by a lot of people, but it sounds like you guys are pretty focused on that with this group that's trying to come up with, best practices for those types of things. My question, I guess, is sort of leading back to this, I suppose, Obo Nobo. I'm not entirely sure, but, one of the issues has been around shareholders being able to get access to the meeting, and you touched on this. And it sounds like the issue has something to do, especially with holders and street name, being able to get access to the meeting. And I think you touched on that, but I didn't quite understand the issue. But if I understood it correctly, it seems like some of the fixes to the proxy plumbing and the voting tabulation would also address the accessibility to virtual meetings at the same time. And I think Obo Nobo is in there somehow as one of the impediments that's sort of making this difficult. Can you help me understand that better?
I can try. I can tell you, we've had a dozen meetings with these people in the last year, and I still don't have the lingo. In fact, I still had to call somebody today and say, let me see if I'm saying this correctly. It's very complicated, but the Nobo Obo issue is related to the access issue, but we're trying to do a smaller fix for this year. If you are a beneficial owner and you want to attend a meeting in person, you could usually just show up with your brokerage statement and prove that you were an owner. That doesn't work in a virtual meeting. So if it's a Broadridge hosted meeting, because Broadridge has the lion's share of the relationships with the brokers, and that feed from what's held at the brokerage account and who holds it goes back and forth easily from the brokers to Broadridge. When Broadridge hosts the meeting, your control number that you get in your email to vote is the same control number you can use to get in the meeting. So the majority of the meetings worked fine. But when Broadridge couldn't host the meeting, either because of bandwidth issues or because Computershare or Equinity was hosting, you couldn't use that Broadridge control number. Say if you have a share, if you hold at Merrill Lynch, you get your email from Merrill Lynch, here's your shares to vote, and you do it. But to get into a non-Broadridge hosted meeting, that control number wouldn't work. And it's because Broadridge and the other providers don't share that data. So what they've agreed to do, and this is again to level the playing field for all the providers, and I give Broadridge credit for doing this as well as for the others, but they've agreed that the playing field wasn't level, because to try to get a legal proxy and spend 3 days just to attend a virtual meeting is difficult. So they are doing this, basically it's a computer, it's an interface where Broadridge will be able to validate that the person is a beneficial owner based on the records they have from all the broker clients. So they'll see the Merrill Lynch, and they'll know, and then they can tell Computershare or Equinity, yes, this person is a real shareholder, let him in. There's a separate, again, so then if a beneficial owner wants to show up at a virtual meeting and actually vote, that's a whole nother ball of wax. There's a separate computer interface for that, because if you're a beneficial owner, chances are, your shares, either you've already voted them or the agent, your advisor's already voted them. So if you want to show up and you've already voted, that somebody needs to know that, because if you want to vote again, change your vote at the meeting, then that's an issue. That doesn't happen very often at all. But again, we're trying to build a system to work just in case, because again, the definition of having a meeting and having a virtual annual meeting means somebody can show up and vote, So we have to handle both of those. But the Novo Ovo group is looking at those communications issues, but it's a little different than the actual access. But it does only apply to the beneficial owners, and most of them are retail holders. I have been made aware that a lot of the investors that may want to show up at a meeting, the institutional investors, they know the drill. They know they have to get a legal proxy. They've probably got a large stake. They go to their broker in advance, and then they know that they, number one, have to be known, when they show up, that the issuer is going to know who they are and that they're in attendance. And if they don't want to be known, then they don't show up. But those kinds of issues are new for the retail kind of side. So that's primarily where the complications are. But believe me, it's not easy for me to explain, and I have to say, I might not be explaining it exactly perfectly, but it's the way I understand it today after listening over and over for the last few months.
Well, thank you. So this, this panel, I think, has generated, at least in my mind, a lot of sort of forward-looking policy questions, and I just want to toss out one of them for each of our panelists. So, for Matt, one thing that I've often wondered about is, does the difference between an average management and a really great management really have the most impact when economic times are good or when they're bad? And has this episode taught us anything about that? And does that suggest any changes in executive compensation models going forward? For Colleen, I'd like to ask. So one of the criticisms at the time of internal controls reporting is, well, this is going to be inflexible and kind of one size fits all. And has this episode given us any insight into whether that is in fact the case? For Darla, should virtual shareholder meetings become the norm rather than a sort of an emergency exception? So Matt?
You want me to kick off?
Sure.
So
Sure. I wish I had the magic ball that could tell me which management teams were average and which management teams were above average or exceptional. That would make this whole process a lot easier. And the reality is that as shareholders, there's really an information asymmetry between sort of what we have as shareholders and what the board has. When they're evaluating management's process, management's execution over the course of the year and sort of making executive compensation decisions. So what I think this, the current pandemic creates the opportunity for is for boards and management teams to revisit how they share that information with shareholders through the disclosure around their evaluation of management's quality and the decisions that they're making. Especially you can sort of think about it theoretically, right? Companies, because of the pandemic, their sort of predetermined performance criteria is not achievable, unlikely to be achieved. And the board has to think about how do they communicate management's performance to shareholders in accordance with any sort of compensation decisions that they choose to make. And that opens the door for rethinking sort of how that happens. It's not a matter of sort of this is what the quantitative formula produced in terms of how well management did. Instead, this is how the board went through the process of understanding management's performance against their expectations. So I do think that there's an opportunity there for shareholders to have better insights into sort of the management decision-making process quality and the board's assessment thereof, because that's really what we elect the board to do.
Great, thank you. Colleen? Colleen, I think you're muted.
Thanks. So it's a great question. I don't think I can answer it as well as I would like to. So first, for what it's worth, I totally understand the concern that internal control reporting can be one size fits all. I think that, like the example that I mentioned with the SPAC, that, so many of them are going to have internal control weaknesses because they have one person in like the finance arm, and then they report a weakness like, well, yeah, by definition. And that it's not helpful for the shareholders and it doesn't make sense. With that being said, I do think that COVID has shown us we can't have a system that every single company has the exact same internal controls. We need it to be flexible. But companies do have issues in a lot of the same areas. And, the examples that I had on the PowerPoint are really examples that are reflective of what I was seeing in many, many different companies. And they are actual internal control weaknesses. It is a weakness if, all of your employees are at home working on their home networks, and you do have that risk for cybersecurity. So yes, I understand the concern that it's, one size fits all, and that's frustrating. But I don't think it's a reason to not, I don't think that's a reason to not have internal controls and to not have those systems in place. And I think it's just a matter of, making sure that the company is flexible and you're implementing them in such a way that it's true to the company. And, I actually think that the market, when you have a weakness and you report a weakness, that's, company specific, and that maybe doesn't really make sense, but you have to do it because it's within the framework. You don't see a lot of market response to that. So it seems like, yes, we're reporting it, and, but in those instances, I think the market actually does see through it. And so I don't view it as a reason to not have sort of a more rigid internal control reporting environment. I don't know if that quite answers your question, but.
It does. Thank you.
Thanks.
Darla?
It's a great question. And I think I heard a news show on the news the other day about business travel taking 2 to 3 years to come back, and maybe never, because what we've learned is, you can do your sales meetings. You don't have to be face to face. I think that virtual meetings will be much more used, even in a non-emergency situation. I think there are a lot of companies that do want to go back to in-person meetings. It's basically going to be a cost issue. Large cap, Fortune 100 companies with a lot of people in attendance have more expensive meetings than some small companies where they get no proposals and hardly anybody shows up. And they do it in a conference room at a law firm. So you've got a huge gamut of, what kinds of annual meetings are there. And if you're trying to figure out whether you purchase a piece of technology to have a virtual meeting that's more expensive than having it in person, I don't know where they're going to come out on that. Yes, it does allow more shareholders to attend, which is a goal, but I don't know at the end of the day where companies are going to come out on that. So it's a very good question. I think it'll really be kind of company dependent. It'll depend on cost as well. And, maybe, you'll hear investors say that, a hybrid is the best because you do get people to come in, who can participate as well as be there in person. That is actually the most expensive, of course, way to do it. So only, I would say, the very largest companies might ever go to fully virtual. But there are certainly other alternatives. If you just want to watch and you don't want to vote, companies can post the video of their meeting after the fact and somebody could watch it, or their audio after the fact. So there are other ways. I think the technology will come along too. And I think if nothing, we've learned from that what we're doing now is so different than what we used to do. So it's a great question. I think if I really knew the answer, I would invest and retire. But
Thank you.
Thank you, and thank you to the panelists. This has been great. So my first question is for Matt. You noted several expectations from State Street related to disclosure and also pay design. I know that the bulk of the U.S. proxy season was in the spring, but there are some kind of later meetings happening and some proxy statements still coming out. Can you speak to whether you're seeing any improvement in some of the areas you identified, some of the trends you're seeing from companies?
Yeah, thanks, Cambria. It's definitely been interesting to watch over the course of the past year, sort of how things have evolved. As you alluded to, the folks that, a lot of the voting that we did in the spring were on compensation decisions that were made, even in January and February before the, breadth or seriousness of the pandemic was even understood. And we had to take that into account. And we have seen, a trickle of meetings coming over the course of the past couple of months. And I'd say the disclosure runs the gamut. We've seen concerning situations, and that's part of why we've tried to be in front of telling companies what our expectations are, where, the companies said essentially, we didn't really hit our performance targets, or we barely, hit the thresholds, but we provided additional compensation because of COVID, and there isn't really much expansion on that. And I think what we want to sort of set up for the market is that, because of COVID, probably isn't the most robust disclosure or the expectations, but we don't want to discourage companies from making the decisions that are right for them and their people when they provide us with the information necessary to evaluate that. So I think that's really what it's about. Is we have seen the gamut. Some companies have been really great about describing sort of the balance that they've had to work out, especially those with mid-year fiscal year ends, where half the year was in a pre-pandemic performance environment and the second half was post. And so what do you do there when sort of there's that extraneous event, and you have to evaluate sort of two performance scenarios. And so, like I said, for us, it really comes back to that opportunity to communicate around how you evaluated management's performance, what you were focusing on, especially on some of those non-financial factors, and then how does that link back to the evolving strategy? Back in March, we recognized as investors, we said we recognize that the time frame that you're going to look at from a strategic perspective necessarily needs to shift as you deal with the moment here and now. And companies now are faced with sort of thinking about how is their strategy going to evolve, how what's going to be a permanent change, what are going to be some of returns to, the pre-pandemic operating standpoint. And, compensation, again, provides that opportunity to communicate around that and demonstrate how you're holding executives accountable for executing on the various strategic priorities as they evolve, and things become hopefully a little more clear.
Thanks, Matt. And I have another question for Darla. I know you highlighted a few issues right in the beginning, and one of them was 10b5-1 plans. And at the risk of nerding out a bit, actually, I'm interested to hear about what the conversations have been around those, and what you were planning to say about that.
Well, I had a really long section only because I watched CNBC and I saw Chairman Clayton on there taking some questions about it because it's in the news. It is our members that sort of, help set up these plans and know about them. They govern, they many times administer the trading window for their companies. So it is in our area, but it is not something we talk about a lot. We did a very extensive survey. I think it was in late 15 and early 16. So I have a lot of data, and I thought I might give it on how the plans were working, but that's now 5 years old, so I'm a little bit loath. My staff said to me, I don't know that you should really highlight that because I don't know if that is old and but I certainly, we're going to update the survey soon, so we'll have better data, but I can give you some highlights of what our research showed in 2015. In 2015, about 25% of all public companies had 10b5-1 plans, and but more than half of the S&P 500 had them. The vast majority, I think it was 85% of the companies actually review and approve the plans, but only 35% of the companies had restrictions on any types of provisions. We think that's increasing, but there weren't a lot of restrictions on the provisions back then. Most of them did not have a minimum or maximum term for the plans, but when they did impose a minimum or maximum, the minimum was about 6 months. The most frequent maximum was anywhere between 1 and 2 years. I know that there's a view that these should be maybe longer. Most of the plans did allow trading during a blackout for a variety of reasons, whether it's selling for tax reasons or whatever. Most of the plans did have a cooling off period, which I know is something that Chairman Clayton talked about. And the most common back then was only 30 days, which doesn't sound maybe as long as it should be, but that's what we found back then. We did find that several of the plans could be terminated at any time for any reason, but with the proviso that, good faith could be questioned and people would look askance if you did it, too often. There was a wait, the wait period required after you terminated to put in a new one. Most of the companies only allowed termination during an open window period when the executive did not have public material non-public information. Anyway, things like that. Only about a third publicly disclosed the adoption of their 10b5-1 plan back then. I don't know if that's increased. Again, I'm a little bit jumping the gun because we're going to do some more research, but there's certainly reasons why a company would not want to disclose as well, just to try to tip the market as to what they're doing. But they're complicated. They are, we think that they're necessary and should be used, the right way for executives that are compensated so much in stock and really don't have a lot of open window periods to sell. So if you can do them fairly at a time when you're not in possession of non-public information, which is the basis for doing one. All of them were put in place originally when the executive did not have non-public information. It is a good way to try to sell your stock down over time when you can't do it just anytime you want to. If you have a life event, you want to send your kid to college or buy a new house, typically. Anyway, I was going to mention it just because I'd heard that it was in the news, but there's a lot there. There's a lot of detail in the plans and how they can work and how they can't. So we're going to try to get at that in our survey, and we will be happy to. I mean, you can look at the old one if you want. It's probably on our website, or I can get it to you if you want to email me. But
yeah, I would definitely be interested in hearing or seeing the updated information once the survey's done, and certainly, you know, a COVID in a COVID environment as well. I think it would be very interesting. So thank you, Darla.
Okay, thank you.
Thank you. So I think we've got time for one more. JW?
Yeah, and the 10b5-1 plans just spurred me to think maybe we should have something similar from members of Congress, given how much we read about them in the news recently. Maybe that's something for the SEC to consider and propose. Just a question for Darla, just to underscore something that you said already about virtual shareholder meetings. I know there was some skepticism from the Council of Institutional Investors about VSMs, and there still is. And it's always kind of surprised me. I mean, I understand the push to, and I think investors should push to comply with the guidelines that y'all did this summer. I think that's great. And I think if there are technical issues, fix the technical bugs. But to me, it's just a no-brainer that you're increasing the option to have virtual-only shareholder meetings. Just increases shareholder participation. You know, the best example, this was told to me secondhand. I didn't hear it directly, but I think at a meeting this year, the legend goes, John Chevity said, "Wow, this is great. I love this. I just participated in 3 shareholder meetings in 3 different time zones." He's a shareholder advocate and proponent of proposals. You know, which I'm not sure the CEOs all loved having more Chevity in their life, but it's more shareholder participation. I think it's a great option. I just don't understand the pushback, and I hope that CIA will take a look at that. I'm glad you all did the guidelines. I think they're great, but I think it's an option that should be on the table. So,
yeah. I think CII has softened a bit for that very reason, but they still are worried that, you know, it's not like the virtual meetings audio only. It's not like looking the directors and the chairman in the face or whoever's, you know, speaking. It's not like standing in front of the mic and I mean, Matt, you can correct me if I'm wrong, but, you know, I think that's what they really want. You know, the trade-off is you can do one of those in 2 days if you have to fly to it, you know. And so if there's a company you really want to go to and you really want to look somebody in the eye and hold them accountable, you can't do that very well in a virtual meeting. So it is a trade-off, but on balance, I think, you know, the virtual meeting was certainly very good this year, and I think they'll be around for a while.
I'll add, I do think companies did an excellent job with very little time and foresight to, you know, pivot and use the technology effectively over the course of the past spring. And it'll be exciting to see what happens with more than, some cases, 2 to 3 weeks to plan and execute on a virtual meeting. I think, you know, hopefully there'll be some great innovations in the coming spring, because, you know, when companies want to use the platform effectively and do a great job and, you know, try to emulate or create a similar experience to that of an in-person meeting, it can be a good platform, especially in the current environment.
Yeah.
But as you did note, there are some drawbacks as well, and, you know, those need to be continuously addressed and taken into account.
Thank you. This has been a really excellent panel. I know I learned a lot, and I'm sure everyone else on the IAC did. Matt, Colleen, and Darla, thank you so much for your time. We really appreciate it. And I will now turn it back over to Jennifer.
Thank you, Paul. And echo my thanks to all the panelists. This is a really fabulous session today. Now we're pivoting to the last portion of our meeting, which is reporting from our subcommittees as to things they've been discussing. So Heidi, can we start with you?
Charlie, thanks, Jennifer. So, as we've been talking a lot about the issues that are on our tab for further consideration in the Investors Owner Subcommittee. Under the broad umbrella of disclosure effectiveness, we have quite a few topics that we're thinking about and will probably develop more in 2021. We want to look back at the CorpFin's disclosure effectiveness initiatives and sort of see how they have turned out. We have a number of, I would say, disclosure-specific issues that we think may be very important to certain types of investors, and I think we want to do a deeper dive on those. We also talked about sort of just a framework for policy making in the area of disclosure. I think very much spurred by the discussion this morning about the natural tension between principles-based disclosure requirements and rules-based disclosure requirements. So I think our subcommittee is going to continue to focus on disclosure issues, many of which were discussed well today. The second major topic we have on our tab is one that we've been discussing for several meetings, and that involves self-directed IRAs. I know Chen and the Investor as Purchaser Subcommittee is also focused on that area, and this, I think, will be an area where we will continue to collaborate, mostly trying to understand, what, if anything, the Commission can do to enhance investor protections in this area. And last but not least, under the heading of proxy plumbing and corporate governance, I mean, all the topics we just discussed on the most recent panel are certainly on our tab. I think, we would look forward to seeing something to perhaps solidify the effectiveness of virtual meetings. I'm very interested in the best practices that Darla spoke about. And then, of course, there is some interest in looking at proxy voting disclosure and getting a better sense to ordinary investors of how their investments are being voted or their governance issues are being pursued.
Thanks, Heidi. And Chen, since Heidi name-checked you, should we move to you next?
Thank you, Jennifer. Thank you, Heidi. So yeah, in the Investor as Purchaser Subcommittee, we did in fact actually spend a lot of time, Heidi, discussing IRA rollover issues and how to kind of get some direction there, especially in the area when there's not an advisor actually. Where is the education coming from? Where is the advice coming from? That kind of bled into the discussion of online trading platforms and whether or not investors truly understand what they're getting into in terms of trading on margin and things of that nature. For example, options, futures, that kind of stuff that some of these online platforms have. We kind of discussed that with the onset of COVID and people working from home, it appears that the volume of trading has gone up on a lot of these platforms because it seems like there's time for people to do a little bit of that. And then lastly, we were kind of concerned a little bit about, again, we didn't really necessarily define whether it's a disclosure issue or whether it's an education issue per se, but the use of derivatives and inverse ETFs and do investors, retail investors, truly understand how much risk they're taking on, leveraged ETF or something of that nature? Is there enough information or education or disclosure around that? So those are some of the issues that I think Investors Purchaser Subcommittee will be working on. We'll certainly be collaborating with the Investors Owner Committee on that, the IRA discussion. I think that and some of these issues that we've talked about today in the panel segue very, very nicely into what we're talking about. So I look forward to that. And that's pretty much it.
Thank you, Chen. We'll turn to JW now.
Thank you. And though I know that some of y'all probably visited other subcommittees, we're still here. It's not too late to make your decision yet. Sorry, I had to move to Toyland here, but in terms of topics for future meetings, we've got 3. One of them relates to credit rating agencies. We had some discussion about, we've already had one discussion just before COVID, a credit rating agency panel, y'all remember, and we got into a lot of issues. But then COVID hit, and I think hitting credit rating agencies again as a topic with respect to their performance during COVID would be useful, I think helpful. And so that's topic number one. Topic number two is doing a retrospective look at the future of market, a retrospective and a prospective look at market structure after the pilot was struck down in the DC circuit. There are issues with respect to rebates and fees to think about, and also related issues with respect to other parts of the Reg NMS design, including the trade-through rule. That could be part of a discussion about large-scale change to market structure that we might see under the new commission. So that having that topic on the table would give us a chance to be a part of that conversation with the new chairman and the new commission and the commissioners. Third topic is with respect to best execution. Commissioner Roisman has asked us to take a look generally at best execution. And we've got a few ideas there, and Mina has volunteered to help with her expertise in this area and her context in this area. So we're going to develop a proposal for a topic on best execution. And that would have some overlap to some of the stuff that Chen was talking about with respect to, I imagine, would be related in some ways to the app-based trading sort of stuff. And then finally, those are three topics we have for y'all if the executive committee and if our chair is interested in. Finally, we do have a proposal directly related to credit rating agencies that we've been discussing and that we will look at as a subcommittee in January. Just to give you a little bit of idea what it is, it's public reporting of annual inspections inspired by the regime that the PCAOB uses. The PCAOB has a semi-public, semi-private report it does on each firm. We think that the Office of Credit Ratings here can learn from the PCAOB's approach, and so we're going to work up a recommendation based on that.
Thanks, JW. And before we adjourn, Rick, I think you had some comments.
Yeah, thanks, Jennifer. I just wanted to make some thank yous. First of all, we've gotten through another meeting without any real technical glitches, and I think we all know that that's not something we should take for granted. So I wanted to say thanks to Nick and the other people in the Office of Information Technology that help us actually pull off meetings like this. Also wanted to thank the folks in my office that work behind the scenes to support the work of the Investor Advisory Committee. And in particular, I know Paul mentioned earlier this morning that this is Tony's last meeting, Tony Tornatore. She has really provided a lot of support to the committee in the last several months. She actually, we borrowed Tony from the Division of Enforcement several months ago. Little did she know that we'd be going into this lockdown environment and we'd be having, extra IAC meetings and that she'd be handling that virtually single-handedly. She's done a terrific job for our office. So I hate to lose her back to enforcement, but I appreciate their willingness to give her to us for these last months and wish her well and thank her for the work that she's done. A couple other things I wanted to mention, as you know, this is Jerry Solomon's last meeting. So I'm sure I join all of you in wishing him well. For those of us that have been on the committee with Jerry for a while, you know that he's one of these guys that has such a deep level of expertise that, while he may not speak up all the time, when he does have something to say, all our ears perk up because we know it's going to be something that's really thoughtful and meaningful and contributes so much to the discussion. So we'll miss that from Jerry, but we thank you for the 4 years that you've given us. And then I also wanted to mention Craig Getch wasn't on the call today. Leslie Van Buskirk from Wisconsin is a new member of our committee, and she will be representing the state securities regulators. And she's actually taking the baton from Craig. So Craig is stepping down from the committee. Craig has been on the committee since its formation more than 8 years ago. Another person that's been a real worker bee and has just really contributed to our work. He's as a state securities regulator, he's really close to the investing public. He's a former president of NASA and has sort of a deep and wide understanding of a variety of issues that we've dealt with over the years. And so we'll really miss his contribution, although I also know Leslie, have known her for a number of years, and look forward to her contributions that we will no doubt see in the months and years ahead. So just wanted to make some thank yous and recognize folks before we bid adieu today. So thank you, Jennifer.
Oh, great comments. Thank you, Rick. Yes, thank you so much to Tony. A fond farewell to Jerry. I also want to thank Adam Anasich for all he's done to make sure we know what we're doing today for the meeting. The technical staff at the commission, it's been a great day. Thanks, everyone. I look forward to seeing you, probably virtually, I assume, but at our next meeting. And enjoy your evening. The meeting is adjourned.
Thank you.
Thank you.